We think inflation is going to continue to move lower once we get past this little bump related to tariffs.
The pass-through of the tariffs into inflation has just been a lot slower than what I'd expected.
Tariffs are going to increase prices.
I don't think that we should be pulling our hair out that inflation is about to take off again.
If inflation starts accelerating, I mean, you can't rule out that they skip December.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. President Trump slapping another round of tariffs on specific sectors on goods overnight. Europeans privately warning Russia of plans to shoot down jets intruding on their territory. Big investors from David Einhorn to Ken Griffin are worried about a tech bubble. And markets, Annmarie, are largely ignoring it all.
Largely ignoring it, even though there is now fresh uncertainty in this market from a number of issues, whether or not the AI spend is actually going to be tangible. And then, of course, policy, once again, out of Washington. The markets have become almost numbed when it comes to trade and tariffs out of this administration. Trump comes out, shock and awe, on a number of issues, most notably for financial markets is pharmaceuticals. But then you start to really read into the story and you realize that there's going to be exemptions, there's going to be carve-outs. So at the moment, carry on and keep going.
Well, right now I hear but yelling in my ear saying this was the first week potentially. 3 straight days of losses. First time that we've seen that in September. Going back to August 21st, we have not seen that type of trend. We could see a down week for the first time and potentially the most going back to middle of August. There was this fear percolating in markets, and I feel like it took on a new life this week, Annmarie. This idea that maybe the tech investments were getting a little ahead of their skis, and we saw a real pile-on with that type of concern, albeit not necessarily expressed in any kind of prolonged sell-off.
No, because guess what? We're still, just short of record highs on this stock market. But you are starting to hear, and I think this week it has been a change of tone and rhetoric. People are starting to take pause. They have a fear of missing out, but at the same time, history doesn't always repeat itself, but it rhymes. And everyone's thinking about what happened in the dot-com bubble. You look at what David Einhorn said yesterday, famed hedge fund manager. The numbers that are being thrown around are so extreme that it's really, really, really hard to understand them.
Which is the reason why we saw just a little bit of a dip. But this morning, we're trying to push forward a real question here also heading into 8:30 a.m. Eastern time when we do get core PCE. That is the metric of inflation the Fed is watching, along with personal income, personal spending, a fear percolating into markets that maybe the Fed wouldn't move quite as quickly as people had expected.
Well, Neil Darda, one of those individuals who's been calling for the Fed to be cutting rates well before they started this month, saying that, if you get hot inflation prints, potentially you have a pause, say in December when it comes to the Federal Reserve. And yesterday's jobless claims, they were so good, those numbers, that potentially now the market is going to focus a little bit more maybe on CPI and that concern, because there are still members of the FOMC that are concerned about tariffs and their impact on inflation.
Yeah, right now we are seeing markets that essentially aren't doing much, but they're not going down. And that's giving people a really positive signal, at least apart from the NASDAQ. We're looking at S&P, just basically the futures up about 0.1% across the board. The euro claiming back some ground after losing against the dollar, weakening, the most going back to July 31st on 2 days of upside surprises in economic data in the U.S. And this feeling that maybe the Fed isn't going to go quite as far as fast as people expected. How important is going to be that inflation read at 8:30 a.m. Eastern? Coming up this hour, we're going to be speaking with Cameron Dawson of NewEdge Wealth. His stocks look to snap their longest losing streak in a month. Alex Haissl of Redburn on why he has the street's lone sell on Oracle. And Mike Darda of Roth Capital looking ahead to the latest read on inflation. We begin this hour with stocks little changed as investors await PCE inflation data. Cameron Dawson of NewEdge Wealth writing this. Equities have been in melt-up mode, which helps to explain the recent 3-day breather we have seen in shares. But we are still very much in an uptrend and continued positive weekly momentum. Definitely an understatement, Cameron. We look at some of the valuations. Cameron joins us now, which is a wonderful thing. Cameron, I just want to start with the question that we were kind of bantering about, this idea why the market isn't responding more to the new bazooka of tariffs announced overnight.
Well, because earnings estimates continue to go up, and you use the word numb, and it's sort of an uncomfortably numb kind of scenario where we have not seen tariffs impact earnings estimates. Look at the second quarter earnings season. big surprises to the upside because people were expecting tariffs to hit earnings immediately, and they didn't. And so companies raised guidance and gave good outlooks. I think the question is, as we go into the third quarter, do we start to see some of those tariff impacts start to hit earnings where investors will look at the layout of tariffs and say, maybe this is more of an earnings negative thing than what we experienced just in the second quarter?
Well, this to me is really interesting because a lot of people are saying that this market momentum hinges on earnings. And if there is one bad earnings report, that could potentially torpedo a lot of this momentum. Is this how you see things, or do you think it's a little more complicated than that?
Well, we've been saying that the key reason why the market continues to make new highs is because 12-month forward earnings estimates continue to make new highs. But it must be noted that the majority of those earnings upside is coming from just a small handful of names. Michael Simplus put out a stat earlier this week that said over the last 3 years, 80% of the earnings growth in the S&P 500 has come from the AI-related names. 80%, which means that we are relying on such a small cohort of names to drive this kind of upside.
Well, yesterday there was this report in the Financial Times about how Sam Altman, Mark Zuckerberg are getting close to the president, and an insider said, well, we really need that AI investment. This is a marriage of convenience because the economy wouldn't be doing so well without that AI investment. What would this market look like with actually out those trillions of dollars being put towards AI?
It would look like the equal weight index, which might be near new all-time highs, but on a relative basis, it has significantly underperformed the cap-weighted index, which just is a reflection of the fact that equal weight earnings are still getting cut. You're still seeing earnings revisions lower. The cap weighted is going up because you have this benefit from the large AI-related CapEx names. And so as long as that continues, we would expect this market to remain narrow because earnings growth is narrow.
What do you make of the likes of David Einhorn being a little bit nervous, saying it's really, really hard to understand these types of numbers?
Completely agree. We've been writing for the last couple of months that it's fascinating that these businesses, which were very capital light and near monopolies, are now transforming into capital intensive businesses that are much more competitive. That says to us that return on invested capital will go down for these businesses if they continue to spend the way that they have. The question is, when does the market care? The market hasn't cared because the Mag 7 has grown earnings at a 40% annualized rate for the last 5 years. So if that earnings start to level off, if top line growth starts to level off, that would tell us that the market will start to care about return on invested capital degradation.
There also is this idea that they're using free cash flow to make these huge investments. And suddenly, overnight, we're talking more about the debt side of things.
Yeah.
And the fact that tech debt issuance is running at a pretty fast clip and seems to be accelerating into the end of the year. How do you view the idea of leverage being introduced to the tech story?
It certainly adds a layer of risk. It's one thing when you spend your own money, a different thing when you spend other people's money. And I think it's fascinating, though, is that there's still a ravenous appetite for this debt. You are seeing these deals be oversubscribed. You're seeing the spread of that debt be very, very tight for the given risk. The fact that Oracle is able to come out with 40-year bonds that are so well in demand just tells you that there is still so much liquidity in this market, and there's still so much optimism related to the AI trade.
There are a lot of worries out there. There always have been. And I think 2008 conditioned everybody to look for the bubbles and the potential pitfalls ahead. I do wonder, though, how much this is just turbocharged by a Fed that has shown its cards and that essentially it's going to have some sort of easing bias. Is there a real kind of catalyst in this 8:30 a.m. core PCE? Should it come in a lot hotter than expected simply because it stymies the hopes and dreams of the Fed dove watchers?
I think that we have to think of the Fed in two very different camps. Old Fed cares about inflation. New Fed, which we'll get sometime next year, probably doesn't care as much and is going to go to 3% almost in every single economic scenario, which means that you would have to see a very large, meaningful uptick in inflation in order for the new Fed to not cut rates aggressively. So in the near term, it means that you likely, if you get higher inflation, you won't get the rate cuts as soon because old Fed cares about the dual mandate.
Well, can we have new Fed policy with a head of the Fed that's part of the old Fed?
Yeah, it's a great question of, do we actually get that kind of shadow Fed, and does the bond market price it in? It's no surprise. The bond market is pricing in the Fed effectively gets to 3% by this time next year. Then comes the debate, which we heard from Stephen Myron yesterday, which was, where is neutral? If you have a large cohort of the Fed arguing that neutral is far lower, we could be talking about a Fed funds rate that's below 3%. And then the question is, what's the consequence of that? What's the consequence of that on the long end of the yield curve? And then how would they potentially respond to the long end of the yield curve backing up? And do we see this Fed starting to talk about things like yield curve control?
Do you think this idea of a new Fed could actually basically be instituted before Powell leaves? Like in terms of FOMC members actually lining up for what, say, Stephen Myron envisions?
I think right now you're seeing members line up because there's sort of an audition. We think it's kind of like a chorus line where they say, God, I hope I get it. And so you have this audition where they're all talking very dovish things in order to potentially get the nod for Fed chair. But it is an important point that there are many voting members on the Fed. It's not just one person. Myron was a lone dot when we got the 2025 dot. So it's not a given, but we think that the true outcome is still, once we get into 2026, this time next year, that you're likely looking at much lower rates.
You sound concerned. You sound bearish. Are you investing in a bearish way?
Look, what keeps us optimistic is 12-month forward estimates keep going up, and that we're still in an uptrend. And we very much respect the uptrend, and we respect the momentum. And we've been noting that positioning is still fairly not stretched. You have the Deutsche Bank Consolidated Positioning Report that's still just in the 69th percentile. And if you look at the discretionary investors, they're only in the 40th percentile. So there's still money that can be dragged kicking and screaming into this market, which is why we think we continue to remain in an uptrend.
You could hate the theme, but you can love the returns. Cameron Dawson, you're sticking with us. Thank you so much. Right now, let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. President Trump announcing a fresh round of tariffs. The administration is imposing a 100% tariff on name brand pharmaceuticals effective October 1st, unless the companies build manufacturing plants in the U.S. New duties will also hit cabinets and vanities, furniture, and heavy trucks at the rate you can see there. Meanwhile, President Trump also signing an executive order finalizing a deal to spin out TikTok's U.S. business, with officials setting its potential value at $14 billion and shrinking ByteDance's stake to less than 20%. But the valuation is well below previous projections, closer to $40 billion. So far, buyers include Oracle, Silver Lake, and MGX. And lawyers for Fed Governor Lisa Cook asked the Supreme Court not to allow President Trump to immediately remove her, saying the move risks chaos and disruption in markets and would, quote, sound the death knell for central bank independence. The administration has asked the court to permit the president to remove Cook while litigation over the legality of her firing continues. That's your Bloomberg Brief. Lisa.
Thank you so much, Yahira. Up next, increasing the risk of a government shutdown.
This is all caused by the Democrats. They asked us to do something that's totally unreasonable. They never change. They want to give money away to illegals illegally. This is what Schumer wants. This is what the Democrats want.
Tyler Kendall of Bloomberg joining us next. This is Bloomberg Surveillance. Welcome back to Bloomberg Surveillance. John is on a well-deserved day off. It is me and Annmarie holding down the fort. We woke up overnight. There was a slew of information from President Trump having to do with all of the tariffs. This morning, we come into relative calm in markets. But I want to take a look at three specific stocks that are being affected: Wayfair, Restoration Hardware, and Williams-Sonoma. Three furniture-related home goods types of shares. And you can see in pre-market trading, they're taking a hit, led by Restoration Hardware, which had the CEO dropping F-bombs on a recent call, talking about being able to, or not being able to, pass along price increases to consumers. Those shares lowers, the futures down by 4.2%. But Annmarie, it really raises this question of why the broader market isn't responding more. You are seeing small pockets that are seeing a little bit, perhaps, of skepticism.
I'd love to hear what the Restoration Hardware CEO has to say this morning when he sees his share price down after Trump announced these tariffs. So it's a 30% tariff on upholstered furniture and a 50% levy on kitchen cabinets and bathroom vanities. The market is definitely selling this off at the moment, but I still think we need more details from the Trump administration. They're doing this through 232 section tariffs. We need more details on exactly, potentially, are there going to be exemptions? Potentially, do the tariffs come down if you're building more of these products, or at least percentage of these products in the United States.
Yeah, and how much, as you said earlier this morning, how much of this is a hedge against if the Supreme Court does overrule some of the tariffs put on by IEEPA? But to that idea that you were talking about earlier this morning, Annmarie, about a numb market, if you look at the broader price action, you can't see it. Essentially, you're looking at an uptrend, fading a little bit from earlier this morning, but the S&P futures basically flat. You're looking at a 10-year yield, also almost flat, unchanged, 4.17%. And then you're looking at a dollar that's weakening just a touch after two significant days of strengthening on the heels of some better than expected U.S. economic data. Under surveillance this morning, take into account this one, increasing risk of a government shutdown.
This is all caused by the Democrats. They asked us to do something that's totally unreasonable. They never change. They want to give money away to illegals, illegally, people that entered our country illegally. They want to give them massive federal money. And we don't want to do that. This is what Schumer wants. This is what the Democrats want. They want to have, and they want to take our money.
Here's the latest. The risk of a government shutdown rising with funding set to lapse on October 1st. Bloomberg's Tyler Kendall joins us now. Tyler, it seems like almost a certainty at this point, given the schedule of Congress.
Right, exactly, Lisa. We are now 4 working days away from a potential government shutdown unless lawmakers are able to strike a deal. We have to keep in mind here, in order for the bill to pass, Republicans in the Senate need at least 7 Democrats to get on board. And we saw a previous measure already fail. Republicans had wanted to keep the government open through a stopgap measure through November 21st. But now Democrats are trying to use their leverage to negotiate on some other provisions. In fact, I spoke to one senior aide to Democratic leader Chuck Schumer, who told me that they are dug in on this and they feel that they're actually well positioned here because after what we saw happened last time around and the sort of scrutiny that Chuck Schumer was under, it appears that they're going to stay on this path. Now, when it comes to what they're asking for, Democrats have a few different provisions that they're looking to get through when it comes to this spending plan, this government spending plan, but they all have to do with health care. One is extending or making permanent some of the expiring Obamacare tax subsidies. This one might be the one where we actually see the most potential compromise. Senate Majority Leader John Thune has signaled an openness to negotiate on this. But these other provisions that Democrats are looking to negotiate on, including making it more difficult for the administration to claw back previously allocated funding related to healthcare, as well as rolling back some of those changes that we saw to Medicaid under the One Big Beautiful Bill. Those seem a lot harder to get around since they really do go hand in hand with some of the administration's policies that they've been promoting. But Lisa, at this point, as you said, it does feel like we are careening closer to it, and the stakes are just getting higher. President Trump derailed a planned meeting that we had been reporting on that was set to take place yesterday with Democratic leaders, and now there's this threat that there could be these permanent layoffs for federal workers if a deal isn't done.
Tyler, aren't we basically just accepting there's going to be a shutdown because Speaker Johnson told lawmakers, told Republicans, don't bother coming back from your recess until after the clock would strike for it to be a shutdown? So at some point, are they to blame because they didn't even show up for a vote?
Well, that's a good point here. But of course, we know that the administration is working closely between the House and the Senate. All of the moves under the Trump administration have been coordinated when it comes to both chambers of Congress. It's going to be something that we're going to have to wait and see. Of course, Annmarie, you know better than anyone. If Washington loves anything more, it's a deadline. They love to be fueled by a deadline. But at this point, it's been really interesting to see Democrats really dig in on this, including those lawmakers that represent those areas, those districts that take in the most federal workers. Even with the threat that there could be permanent layoffs down the road, they do appear to be pretty dug in. One point that was pointed out to me is that many Democrats have been expected this already, a plan to decrease the workforce when it comes to federal workers already. So the threat from the administration and the OMB memo that we got yesterday didn't really come as a surprise.
Bloomberg's Tyler Kendall, thank you so much for being with us. Cameron Dawson of NewEdge Wealth still with us. Cameron, adding this to the list of things that sound like they could be a problem, but markets don't seem to think will be a problem. Can you reconcile the idea that potential layoffs could cause some serious economic damage at a time when most people are shrugging this off as just simply theatrics?
Yeah, I think it's probably the most important point is that we're not talking about furloughs where people go home and get back pay, but actually talking about firings. So this seems like maybe more of like a shut doge instead of just a shutdown. And So if we have that, though, it's likely that you'll start to see that show up in some of the data. And an important point, you might not get the data when you think you do if we are in the midst of the shutdown, which just means that this uncertainty, as well as the impact, could be a source of volatility.
This is a really important point, given the fact that there's been such a huge emphasis on the labor market and any kind of trend that we might see with respect to firing and hiring if we don't get the non-farm payrolls report on October 3rd, and that's becoming an increasing likelihood. How does the market read that?
Yeah, dancing in the dark, right? In the absence of information, we think it would probably just increase demand for hedges, increase the uncertainty, which just means that this very calm, placid market that we have been in could see an increase in volatility.
Unless they declare someone as essential to push the number, we could maybe not have a jobs report. What does that mean for the Federal Reserve?
Yeah, again, it's something that we really haven't had to deal with. And so the Fed will probably then lean towards other kinds of data potentially to give them guidance. But it probably means that the path that they set forward in the latest dot plot, where we do have the expectation of another rate cut, likely gets delivered. And they'll say, look, if people are actually getting laid off, the jobs data is likely going to be bad, even if we don't have it.
Yeah, but how are you data dependent when you don't have the data?
That's a great question.
You can't be, right?
You can't be.
Besides this economic impact with maybe not having the data you need to make investment decisions or to understand what the Federal Reserve is thinking, does the shutdown actually matter to financial markets?
It typically doesn't. It typically doesn't because we're also typically talking about furloughs. So everything is temporary. If there is a permanence to this, where we see a shrinking of the labor force in the government, I think it's important to note is that so many of the jobs that have been added, even with the revisions lower that we've seen over the last couple of months, have come from the government sector, which just causes you to question where will the uptick in jobs come from to make way or to make up for the fact that you're losing jobs in this all-important area.
You know, I'm struggling with this, and I was thinking about this last night. The headlines were coming out fast and furious. 100% tariffs on pharmaceuticals, 25% on kitchen and bathroom vanities, which, you know, rang true to me because I'm in the middle of a renovation. Like all of these types of things that come through and you think, wow, the world's going to be on fire tomorrow. And you come in the next day and it's nothing. It's just completely calm. Everyone kind of moving forward. There is this feeling of policy immunity. Do you think that can last, that companies can adapt and adjust to such a degree that a lot of the noise is just that, and they can keep doing what they always do, which is making products, providing services, and making money?
The golden rule is that whatever happens in D.C. or geopolitically, if it does not impact earnings, it's likely temporary and something to fade in markets. And because we continue to see this march higher in earnings estimates, which, as we talked earlier, is really dependent on just a handful of names that probably don't care too much about tariffs, meaning the AI-related names, that as you see that uplift in earnings estimates, the markets can shrug this off. The big challenge will be is that at the end of the day, these AI names still breathe the same economic air as we do. So if all of these things cause the economy to do in fact slow down, then that's where this becomes a bigger equity market issue.
Building on Lisa's point, though, the fact that you see all these headlines and the market just pretty much shrugs it all off, besides some specific sectors, does the Trump put still exist?
The Trump put exists, but it's with a strike price that's far lower than we are today. And I think that, remember, if we go back to April, when the Trump put happened, it was when markets were already gapping down nearly 20%, and you were seeing some spicy price action within the bond market. So to think that, given the fact that we're just a couple percentage points off of all-time highs, that the Trump put is here, most absolutely not. You would need to see a much bigger uptick in not just volatility in equity markets, but you'd have to see volatility in bond markets as well to get the Trump put back in action.
All I can say is, Cameron Dawson of NewEdge Wealth, you're one of the best, and you are the only person I know who thinks in song lyrics and who actually speaks in song lyrics as well. And I had to listen to I'm Out With You last night because of your latest note. So thank you. Thank you for that. The soundtrack of Cameron Dawson. Right now in markets, you're not seeing a ton of action, just basically flat after 3 straight days of losses. Coming up, Oracle in talks for a board seat on the U.S. version of TikTok with a price tag that's raising a lot of eyebrows, not for how high it is, but for how low it is. Alex Haissl of Redburn on why he has a sell rating on that stock. Plus, Denny Berger with your morning movers, Intel and GFS jumping on a new White House chip rule. This is Bloomberg Surveillance. Good morning. Welcome back. We are looking at a market that's trying to claw out some gains after 3 straight days of losses, although not really going anywhere. In a world awash with news, but unclear how it's going to shake out in the corporate earnings. Basically flat on the S&P futures. NASDAQ a little bit lower, and Russell 2000 down by about 0.3%. In the bond space, concern heading into that 8:30 a.m. print. Do we see resurgent inflation that could stymie the Fed's plans to cut yet again in October and then again in December? You're seeing that move, particularly in the 10-year space, but nothing significant, less than a basis point up. And then in the currency space, we had seen 2 straight days of dollar strengthening, the greatest amount going back to July 31st against the euro. We're breaking that with a bit of gains in the euro, 116.72. 3 hours away from the cash open. Here is your morning mover segment with Danny Berger. Danny.
Hey, Lisa, what a month it's been for Intel, already up 40%. And we had weight to that this morning with Wall Street Journal reporting that the Trump administration has a plan to encourage the use of homegrown U.S. chips. That plan has been sending shares of Intel higher by 3% this morning, and Global Foundries, that moves higher by 10%. We also have a lot of new tariffs, sectoral tariffs to work through, be it pharma, be it kitchen cabinets, be it trucks. Let's start with trucks, though. The heavy truck tariff that Trump has announced, it's hitting a lot of the European players really, really hard this morning. Daimler Trucks, for example, but PACCAR, a U.S. domestic truck manufacturer that makes 25% of heavy trucks in the U.S., those shares move higher by 5.5%. I should say Volvo Trucks also moving higher in the European trade because it also makes a lot of its trucks for here in this market. Finally, I mentioned some of the things like kitchen cabinets, which gets a 50% tariff, and upholstered furniture that gets a 30% tariff. You can see what a lot of these retail names are doing this morning, getting hit so hard. RH down 4%. Wayfair, that sinks by 4% as well. Williams-Sonoma, those shares down, Lisa, by 2.5%.
Thank you so much, Danny. We're watching that to see why it is so specific and whether it will fade with everything else this morning. On our radar this morning, President Donald Trump imposing a 100% tariff on patent and pharmaceuticals effective October 1st, unless producers manufacture in the United States. Trump's latest levies also impact imported trucks, furniture, and cabinetry, as Danny was just talking about. Meanwhile, European diplomats warning the Kremlin that NATO is ready to use full force, including shooting down planes to respond to airspace violations. That message follows a recent incursion by Russian jets over Estonia, Russian denying the violation. But a real question here, a lot of questions, Annmarie, about how quickly they are willing to coalesce around more affirmative responses to Russia and what their capabilities are to do so.
I think the big question is whether or not the Europeans want to act with deterrence or they're concerned about escalation, which we've heard from, say, the German foreign minister saying this could be Europe sleepwalking into a trap set by the Russians. And I think we need to remember back in 2015 when a Russian jet came into Turkish airspace, was on the border with Syria, and a Turkish jet shot the Russian jet down. And it became this huge flashpoint where the Russians were incredibly upset with Turkey. But NATO then came on the side of Turkey, even though all they kept trying to do was escalate. And that is the fine line and flashpoint that all these European countries and NATO writ large is trying to understand. They want to make sure that they set a deterrence, but they don't want to escalate when it comes to the face-off with Putin.
What's fascinating is just the technical aspects of this. Mark Rutte, the NATO General Secretary, Secretary General, sat down with Editor-in-Chief John Micklethwait yesterday and was talking about how they have the wrong equipment to shoot down some of these drones. It could potentially be $500,000 worth of equipment to shoot them down, whereas these drones cost very little. And they're trying to use technology from the Ukrainians that were developed to try to shoot them down. It just highlights the different nature of warfare and how far Europe is trying to go in order to be prepared to counter.
Yeah, they definitely probably need some more F-16s if they're going to be doing this. I also think it's interesting. We have reporting that there was talks in Moscow with all these envoys, and the Russians said the reason why they had these incursions was a response to Ukrainian attacks on Crimea, and they said Ukraine would not have been able to carry out these attacks without the help of NATO. So we're going into this potential tit for tat between NATO and Russia, and that is why there is this fine line and serious concern about not wanting to escalate, but also making sure you do set a deterrence the way Syria did in 2015.
Yeah, more on that throughout the morning. Meanwhile, back in the United States, attorneys for Fed Governor Lisa Cook are asking the Supreme Court to block President Trump from firing her. Cook's lawyers warning that removing her would cause, quote, chaos in markets and compromise the Fed's independence. We're talking about that extensively, especially as people try to understand exactly what the composition is of the Fed heading into 2026. In the tech space, Oracle, Silver Lake, and Emirati firm MGX are in talks for a 45% stake in the U.S. version of TikTok. Sources telling us here at Bloomberg that the companies are also aiming for board seats. Alex Haissl of Redburn, who covers Oracle and has the only sell rating on the street, joins us now. Alex, thank you so much for being with us. Before we get to your call on Oracle and some of your methodology behind that sell rating, I do want to get your thoughts on TikTok. This $14 billion price tag, given what some people expected would have been a $40 or $50 billion company, was it surprising to you to see that?
Yeah, I mean, it would imply that, first of all, thanks for having me on the show. It would imply there's like a meaningful gain from an Oracle perspective. If the previous expectations was around, let's say, 40 billion, now it comes in at 40 billion if approved. There will be a windfall. However, from an Oracle, share price impact, it's still insignificant. So we estimate that this windfall is less than 1%. So overall, no big implication. Doesn't really move the needle.
You have a sell rating on Oracle, and a growing number of investors are coalescing around, if not the sell, the concern that you raised in your note, this fear that Oracle has expanded too quickly, that people's hopes and dreams for their expansion of their earnings have gotten a little over their skis, and that they're now using debt to finance their build out, not just free cash flow, after kind of running out of that in order to keep spending. What's your take on why there still is so much more downside?
I mean, first of all, with regards to our target price of $175, that's not a bear case, that's our base case. I just wanted to clarify. I mean, what we have seen is we've seen like really big figures in terms of contract wins and also like revenue guide. But our methodology shows that actually the value is relatively small for all of these deals. And so we put out this 60 billion value for the next 5 years of like revenue guide, which is significantly less than what the market is currently pricing in.
You said
with regards to the debt. Sorry.
Oh, no, continue.
With regards to the debt, our view is that the market is also, very likely to underestimate how much capex is required, and we are still in the very early innings of this investment cycle. So the further we go in the ramp, there will be much more capital requirements because operating cash flows are not covering any of this capex to the extent needed.
When you look at these capex headlines, do you just see them and think there's no way this is going to become tangible in terms of earnings per share?
What we say is that the market is underestimating the associated costs with this capex, because obviously you have like depreciation, you have like leases, etc. So we really advise investors to look beyond the headline figures in terms of the real economics. So we see downside risk to consensus expectations on the profit level.
When you say in your note that you think not just the downside risk, you think there's going to be a shift to underlying economics. What about the underlying economics of Oracle don't you like?
I mean, the underlying economics is basically, it's not the business that we know from the cloud business, because traditional cloud 1.0, the hyperscalers have built the infrastructure, have extended server lifetime, and over time they've layered software on top, which was a great, fantastic business because it provided operating leverage, software-like margins. These kinds of transactions are much more like a financing spread, where the price and the costs are fixed. Very different economics. It's a different business model.
Alex, this is a reason why a number of people are agreeing with you and are looking at Oracle as something different than, say, Amazon or Microsoft, and trying to distinguish the winners from the losers. We've been talking about the David Einhorn quote, so I'll read it to you. The numbers that are being thrown around are so extreme that it's really, really hard to understand them. He's talking about the investment in technology and sort of the infrastructure around it. Ken Griffin yesterday of Citadel on AI saying there are obviously echoes of .com. A question over how much money will be lost and who the losers are going to be. How many of the big tech giants are you pinpointing as potential losers in this race that is garnering so much cash?
I mean, that's exactly the reason why we launched on Oracle with a sell rating, because we see their role much more of like financing all of this capex. That's a very, very different business model, where Microsoft, Amazon, and Google that built the data center, built the infrastructure, and layering software on top. These are very different economics, and this is where the mode is created. We just don't see Oracle in the same ballpark here.
But the others can keep on gaining. Is that what you're saying? That Oracle can kind of be in its own world of hurt, can fall out of bed, but everyone else can keep winning and keep getting the valuations that they're currently trading at?
Yeah, so we have buy ratings on Amazon and Microsoft. I think, CapEx is like one part where you buy the hardware, put it in place. But what the traditional hyperscalers do is they spend like tens of billions in R&D to build the software layer. And this is where the economics are very, very different. So if Oracle really wants to, catch up, then not only CapEx goes up, but also R&D has to accelerate meaningfully. And we haven't seen this at this point in time.
What would it take for you to reverse your sell rating?
With the stock being at $175.
So you wanted to hit your price target and then you're good to go for a buy.
And also, I think the other point is we would need to see like a real progress towards like how they can capture, the upper part of the stack. So we would need to see like R&D investments going up. We'd also see like progress in terms of like cloud migration, where Oracle is lagging SAP, for example. So they have to put in place the prerequisites to actually capture the higher value part of the stack, and we just don't see that at this point.
Alex Haissl of Rothschild and Company, Redburn, thank you so much for being with us. This is really the question, and Annmarie, this is really the point that David Einhorn and Ken Griffin are making, and so many other people. There will be big winners, but there also will be big losers, as there have been in every industrial build-out that attracts just the same type of flood of cash.
And that's why everyone is so concerned, because it's just, as Dan Ives would say, the first, second inning. When do you actually start to see who really are going to be the losers in this race, when they're coming out with headlines of billions and even trillions of dollars that are going towards this industry?
And at the same time, there is this idea of creative destruction, right? And that you need to kind of flood the zone in order to get the technology up. So how much is this a feature and not necessarily a bug? Let's get to an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahaira Anand. Yahaira.
Hi, Lisa. Former FBI Director James Comey is facing a criminal indictment. He's been charged with lying to Congress and obstruction. The case stems from his 2020 testimony on the investigation into whether Trump or anyone part of his presidential campaign conspired with Russia to interfere in the 2016 election. If convicted, Comey could face up to 5 years in prison. Meanwhile, Meta is reportedly in early talks to use Google's Gemini AI models to improve ad targeting. According to the information, the move highlights Meta's struggles and with its own AI and pressure to boost ad performance. Those setbacks have pushed the company to consider outside technology, at least as a stopgap, while its new AI team work to strengthen their own models. And Xiaomi has unveiled a new smartphone designed to take on Apple's iPhone 17. The new device, called Xiaomi 17, will be offered in Pro and Pro Max models, just like Apple's, and will be $100 cheaper than the base iPhone 17. It signals Xiaomi going after Apple in the most direct fashion, shifting its branding and timing to measure its products against Apple. That's your Bloomberg Brief, Lisa.
Thank you so much. I believe it's called iXiaomi. Is that what it's called? The iXiaomi 17?
Well, I just want to know what I'm looking up now, what the colors are. Because people are actually interested in the
Because you're going to buy one?
Phone. No, I'm not going to buy an iPhone. Not for the colors. But people are excited about the orange, the blue. I'm going to check out the Xiaomi colors.
The new innovations as we talk about AI. Up next, weighing inflation risks.
I would want to understand why there was an upsurge in inflation and what was driving it, and then sort of think about whether that shock is likely to be persistent or whether the shock is likely to be transitory. Monetary policy shouldn't respond necessarily to fiscally mandated price changes.
Michael Darda of Roth Capital joins us next with a slightly different take. This is Bloomberg Surveillance. trying to break a 3-day losing streak. It doesn't look like we're doing a very good job of it. Futures turning negative in the S&P, in the NASDAQ this morning, across the board, really, as a lot of investors just take a breather. This would be the 4th straight day of losses. We haven't seen anything like that since the beginning part of August, which highlights just what a tear we've been on. It is unusual to see red on the screen. This really is coming ahead of the inflation data that we get at 8:30 a.m. Eastern Time. Core PCE, the key metric for the Fed, under surveillance this morning, weighing those inflation risks.
My view is not one of enormous economic pessimism. I don't think the economy is about to crater. I would want to understand why there was an upsurge in inflation and what was driving it, and then sort of think about whether that shock is likely to be persistent or whether the shock is likely to be transitory. Monetary policy shouldn't respond necessarily to fiscally mandated price changes because that's not indicative of changes to the underlying supply-demand balance in the economy.
Here's the latest. Investors awaiting that PCE inflation data due out this morning for a read on the Fed's next move. Michael Darda of Roth Capital writing this. The Fed appears to be placing an undue amount of weight on highly volatile payroll figures while downplaying forward-looking credit market and financial indicators. Michael joins us now. And Michael, thank you so much for being with us. Why do you think it is so important to look at the fact that we have been above 2% for more than 4 years and seem to still be there, even if on a somewhat downward trajectory?
Thanks for having me on. Well, today is likely to mark the 54th month in which PCE inflation has exceeded the Fed's 2% target. And if you look at the last round of projections, the so-called SEP that the Fed put out this past week, they don't envision a return to 2% inflation until calendar year 2028. So that would be a 7-year period of overshooting the inflation target. And at some point, we have to ask, what is the point of a target if you actually don't hit the target?
Well, this is a reason why a number of people have said maybe the Fed should pause, including some of the Fed members who've been speaking recently, saying they don't want to front load those rate cuts. I'm thinking of Austin Goolsbee in particular from the Chicago Fed. Have you heard anything from the other side of the argument that gives you pause? This idea that over the past 6 weeks or so, there has been a material shift downward in the labor market, that you have heard commentary from consumers saying it's significantly harder to get a job.
Look, it's certainly possible. I mean, the Fed's putting a lot of weight on these weakening payroll figures and the big downward revisions that have come with that. But we did see a similar slowdown, less severe, less pronounced for sure, but a similar slowdown in job growth going into last summer. And then the labor market started to reaccelerate. And I think if you take a step back and you look at forward-looking financial indicators, they're really not giving us the message that the economy's headed off a cliff here, right? Just the opposite. Small cap stocks were up 40% from the April lows until this recent pullback, which is minor considering how much risk assets have gone up. Credit markets in great shape. And we're really not seeing a lot of pressure on some of the high frequency labor market indicators that you would typically see if the labor market were falling apart. Jobless claims usually rise 20% plus on a 4-week moving average year over year going into a downturn. That's not unfolding. We saw the claims figures yesterday actually pulled back pretty sharply. I think we'd have to see a change up in the disposition of some of the higher frequency and financial data that we're just not seeing now to make the case for a much more aggressive Fed path from here. Even just, the Fed following through on the expectations that are priced in for more than 100 basis points of rate cuts over the next year. That seems pretty steep unless the economy really is in big trouble.
If we do have a government shutdown and it's longer than some expect and we don't get the data, what's the Fed going to do? Are they going to have to rely on other sources of data like the high frequency you're talking about?
I think so. I mean, then it'll be more important to rely on financial market indicators. They're not always right, but they are forward-looking in real time. We'll have to rely on, private sector data. We still have tracking estimates that are coming through. And what's kind of interesting is if you look at the Atlanta Fed data, it'll be updated again today after the PCE report. But right now, third quarter real GDP is tracking above 3%. Even if you look at real final sales to the private sector, tracking around 2.7. If the GDP deflator is going to run at 3, you have almost a 6% handle on nominal GDP. And if the nominal economy is growing at close to a 6% rate, I don't know how that in any earthly way accords with a tight monetary policy or the Fed being hundreds of basis points above neutral, as Fed Governor Marin argued yesterday.
And when it comes to inflation, as we wait for the PCE number at 8:30, Powell's words were a one-time increase does not mean all at once. Is he basically giving individuals an excuse to look through hot inflation prints?
Yeah, I mean, this is a tricky situation for the Fed in the sense that, we did come into the year with, the tariff news that was much more aggressive than expected. That is having an influence. You can see it in goods price inflation, which is accelerated. And with sticky services inflation, overall inflation has accelerated, at least on a 3-month annualized basis, pretty meaningfully from where we were a year ago. I think it makes sense to look through some of that, but I do think also the Fed has to be mindful about not slow walking into an accommodative monetary stance. If the economy hasn't fallen into recession and financial conditions are quite growth supportive, inflation expectations are 40 to 60 basis points above year-ago levels, that's really not an environment where the Fed should be easing in a forceful and drastic way. That could end up creating a situation where temporary upward pressure on inflation morphs into, something more sinister. And this happened back in the 1960s. In 1967, the Fed responded to a growth scare and a big drop in the stock market, eased monetary policy by several hundred basis points, and then catalyzed an inflationary reacceleration that was just a complete mess to clean up down the road. So better to avoid that kind of an eventuality.
Mike, why do you think that the break-even rates and other metrics of forward-looking inflation in markets don't seem to be reflecting this type of reality?
Yeah, it's a great question. I mean, the TIPS market inflation expectations are above where they were a year ago, but they're still at levels consistent with price stability. So the Fed still seems to have quite a bit of credibility and should not take that for granted. It comes back to this idea, if the Fed's going to overshoot the inflation target for 7 years and take risks of overheating the economy now with the political pressure on the Fed and the change up in personnel, do we really want to take a risk that those expectations reset 50, 100 basis points higher? If the administration wants low long-term interest rates, you don't do that by taking a risk that inflation expectations jump by 100 basis points. That has not unfolded, so that's very good news. But the Fed really should not take those expectations for granted.
Mike, we just have about a minute. I'm wondering if you've ever seen such a complicated economy where there are so many different themes laid over each other, making it difficult to decipher what's signal, what's noise, what's long-lasting, what potentially is temporary.
Never. Not in, my 25 years plus of doing this. This is a completely unique environment, from the tariffs to the Federal Reserve to geopolitical issues. I mean, this is interesting. So you have to go to the history books, but, you have to sort of ad lib it at the same time. And hopefully we can, watch an array of indicators that give us a heads up. And look, if the data starts to shift, then we're happy to change the view. If we do start to see layoffs pick up meaningfully, if financial conditions, credit markets start to tighten, by all means, the Fed should then be in a more aggressive posture. But if that's not unfolded, I do think they need to be careful about overdoing it.
Mike Darda of Roth Capital, great to catch up with you. Thank you so much for being with us. And this is what we were talking about yesterday, Annmarie, with Scott Cronert, talking about how there are almost two halves in the stock market and the economy, where you have the tech sector and tech exposed, and then you have everyone else.
Peter Thiel talked about this, not a K-shaped economy. He talked about an I, a lowercase I, where you have all that concentration of wealth just at the dot. That could be said for the economy as well as the stock market.
Coming up next, we'll continue talking about this with Mona Mahajan of Edward Jones, Kellyanne Shaw, former senior White House trade advisor, Richmond Fed President Tom Barkin, and Winnie Cisar of CreditSights. This is Bloomberg Surveillance.
This market is priced for perfection in a far from perfect world.
There are some consumer-driven parts of the market that may not be in the best shape.
This doesn't mean you have to run to the sidelines.
We need the market to broaden back out because we need the economy to broaden back out.
You have to figure out who are the winners, who are the imposters.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. Markets taking a breather after a runaway melt-up for several months. New tariff headlines hitting the tape. Markets shrugging it off, although kind of going nowhere. And key inflation data 90 minutes away. John is off this morning on a well-deserved day off. Annmarie and myself holding down the fort as we look to a stacked day. The idea of core PCE, that key inflation metric the Fed does look at, coming out at 8:30 a.m. Eastern, followed by University of Michigan sentiment survey. Maybe John took off because of that. Earlier next week, we see Governor Waller, Bostic, as well as other Fed speakers coming out. And then, of course, Annmarie, the government is probably going to shut down. You put this all together, it seems as though this market is immune to Washington, D.C., even as chaos still reigns.
Uncomfortably numb. That's how Cameron Dawson put it this morning. And I really think that's how the market is reacting, at least overnight, from the latest tariffs coming out of the Trump administration, and also still just looking for more details. A lot of shock and awe with the Trump administration with pronouncements. Then you look at some of the details like pharmaceuticals. Well, if you invest in America or have any sort of investment, you plan on maybe building some of your factories out in the United States, moving some supply chains at home, then you get an exemption. So then when you look to the fine details and some of the text, you're thinking, oh, potentially this isn't going to be as bad. Maybe for some others, like furniture, it could be bad. And I think that's why, though, overall, though, the market is just keep calm, carry on until we get actually the finer points.
Well, and the finer points are going to come with earnings. And this is what everyone keeps talking about, that right now in this blank zone, before we get some more details about how the tariffs are getting absorbed by companies, you just have to look at the promise, the hopes and dreams, the profitability, and this idea that we might be coming out of something of a downturn from earlier this year. I'm struck by the fact that, yes, we have seen 3 down days consecutively in the market for the first time since August. We might see a fourth if some of the losses hold up today. There is a feeling, though, this is just a pause and that there is so much bullishness and no reason to get bearish, and it's pretty much universal.
Well, this is what Cameron Dawson was talking about, a melt-up. The fact that when you look at forward-month EPS estimates, they're making new highs when you look at those 12-month estimates, and that is why the market just continues to almost have FOMO, and we don't want to lose out on this race. But doesn't it give you pause, a little bit of agita this morning when David Einhorn is coming out and saying these are really, really big numbers. This is a ton of money. I'm not quite sure it makes sense.
Everyone's saying the same thing. Sam Altman of OpenAI is saying the same thing and saying, look, this is what happens.
He's behind some of the spending.
He's behind some of the spending, and he's saying that we should keep doing it because guess what? This is how we build things. At the same time, they're going to be big losers. Right now, there are not really that many big losers, although there is a softness to the market. Futures lower pretty much across the board, but just tepidly so after 3 straight days of losses, which has been the greatest streak going back to August 21st. S&P futures basically flat here. You are seeing a little bit of dollar strength emerge over the past couple of days and continuing that today. The past 2 days have been the greatest strengthening we've seen in the dollar versus the euro going back to July, just showing how much of a weakening trend the dollar has been. And we do see yields just marginally higher ahead of that core PCE data. A key question of how much the Fed is going to be limited by inflation that just is stubbornly above that 2% target. Coming up this hour, we've got Mona Mahajan of Edward Jones as Wall Street looks to snap a 3-day losing streak. Former White House trade advisor Kellyanne Shaw on Trump's latest tariff threat, and Richmond Fed President Tom Barkin as a central bank shows signs of division among some confusing economic data. We begin this hour with stocks finding a bit of firmer footing as investors eye a fresh inflation print. Mona Mahajan of Edward Jones writing this: markets are likely to be volatile around major growth, labor market, and inflation releases in coming months as they look to understand if the data flow is supporting the case for further cuts. Mona joins us for more. Mona, great to see you. Thank you so much for being with us. I want to start with that. Is the market much more focused on Fed policy than it is anything else coming out of Washington, D.C.?
Yeah, thanks, Lisa. And look, I think there is a focus on the Fed. The old adage goes, we don't fight the Fed, and this market has taken that to heart. We are up nearly 33% since the April 8th lows, almost in a straight line higher. From our perspective, we are in this period. We're heading towards a seasonally weaker October. There is a bit of void in the data. And by the way, yes, we have headlines looming around a government shutdown next week. All that being said, we kind of take it back to the fundamentals. And, we saw just yesterday a 3.8% GDP print for the second quarter. Atlanta Fed GDP now is pointing to 3.3%. And really what's underlying that or underpinning that is a solid consumer. Now, as we head to the back half of the year, we're going to be watching that labor market closely. Is there further signs of deterioration, or have we seen the worst already? But as we head to 2026, we are in an environment where we will probably be seeing lower interest rates from the Fed. A tax bill is kicking in that could provide some fiscal stimulus. And by the way, we have this secular story in AI and technology that continues to deliver. So we don't yet see this equity market completely rolling over. Could we pause, stall, digest some of these gains? Absolutely. But could that provide some opportunities? Yes, as well.
Can these investors have their cake and eat it too? I'm thinking about what Michael Darda was talking about just moments ago from Roth Capital, and this idea that the Fed is cutting, given that you see stocks at all-time highs, you see credit spreads at really narrow levels, you don't see a lot of stress, and potentially you see a lot of acceleration on the heels of some of this spending. At what point do further Fed cuts support market valuations, but also support inflation?
Yeah, it's a fair point. And look, I think Jerome Powell was very clear to tell us in the last meeting that this is an insurance cut. He's doing some risk management. And historically, when you think about insurance cuts, they tend to be 3 or 4 cuts in the cycle. Clearly, Powell and team perhaps want to get to a more neutral rate. And if you think about the history as well, the Fed likes to be about 1 percentage point above inflation rate. So if inflation, we think, lands in this 2.5% range, perhaps a Fed funds rate at 3.5% neutral does make sense here. And if they get there in a gradual way, that gives them some flexibility as well in case the economy moves higher or lower from there. So I do think that Jerome Powell wants to take out this insurance rate cutting cycle. He doesn't want to be overly aggressive, and he's very mindful of the inflation picture as well.
Well, what if we get more prints like we did yesterday with jobless claims falling to the lowest level since mid-July? Can they continue to take these insurance cuts?
Yeah, look, I think they're watching the labor market closely. They understand the dynamic that's going on. It's a lower supply and a lower demand of labor overall, so we will probably see lower job gains going forward. All that being said, they are mindful that labor market can be the last indicator, and it can move rapidly lower. And so I think that's why Jerome Powell is on alert that this labor market should not move into a weaker state that could actually risk this economic growth that we're seeing. So I do think jobless claims are supportive of labor market, but we'll have to really watch that unemployment rate. We'll have to really watch what's going on underneath the surface in terms of job openings, layoffs in particular, and that unemployment figure moving higher. So a set of data ahead of us. Jobless claims, though, I think do point to the picture of, well, perhaps we can go at a more gradual pace.
Mona, I'd love to just also get your thoughts on the tariff-induced potential for inflation. Given the fact that overnight we had more tariff announcements from this administration, the market seems to be shrugging it off. Are latest tariff announcements going to be a cause of concern for this Fed?
Yeah, I think certainly earlier this year, the market was very concerned that tariffs would cause inflation to perhaps even spike back to some of the levels we saw post-COVID, where we were close to 8-9%. There were definitely projections of getting back to 4 to 5%. We have seen none of that come through. In fact, inflation, while it is elevated above the Fed's 2% target, has remained in that 2.5 to 3.5 type range. And part of that is because we know the inflation basket is, of course, especially on CPI, about 2/3 of it is services, 1/3 is goods. And yes, we are starting to see goods inflation rise, but we also know a lot of corporations have absorbed the costs, put those pressures back on their supply chain or diversified their supply chain, and some has been passed to the consumer. But overall, the inflation picture, we think, has remained contained. And I think the market is taking that as a positive sign. Even as they're hearing more tariff news, they are projecting perhaps, yes, 1/3 of the goods basket may be slightly at risk, but the 2/3 that is services has been a little bit more contained and has actually started to show signs of actually cooling a bit. And so if that story plays out over the next 3 to 6 months, you could actually see the inflation picture moderate. And we know over time, tariffs hopefully are a one-time price increase, and then we'll see a stabilization, especially as that year-over-year projection comes into play.
Which is a reason why the Fed is possibly going to look through any near-term bumps. Mona, before we let you get on with your day, what will you do if we don't get a labor market report next Friday because of a government shutdown?
Yeah, it is a real risk. And I think we will have to use the data that we're seeing in real time. We talked about weekly jobless claims figures. We'll also be having to look at the other data holistically. We have an Atlanta Fed GDP now out there, and hopefully this government shutdown will not be a prolonged one. I am hopeful that both sides can come to a resolution, but the data risk is a real one, but not one that can meaningfully derail the broader story that we're seeing in the economy and the market.
Mona Mahajan of Edward Jones, thank you so much. Have a wonderful weekend as we parse through all of these details and headlines. It's just sort of amazing how we are dealing with so many different issues in Washington, D.C., a lack of clarity, trying to understand. It could increase prices here or there. CFOs are getting big headaches. People in the market have confidence they can figure it out and they don't have to care about it.
The only certainty is that there'll be continuous uncertainty out of Washington. And I think it's going to be fascinating if we do have an extended shutdown. As we did in 2019, it was some 35 days, the longest in history under the Trump administration. What happens to the economic data? They need to decide that someone is deemed essential at the Bureau of Labor Statistics to literally put out the release. Because if not, we're not going to have the economic data. The market's not. And then, of course, the Federal Reserve.
Yeah, and if we're relying on jobless claims that we got yesterday, it's not exactly indicating a drastic need for accommodation. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Anand. Yahaira.
Hi, Lisa. Google is asking the U.S. Supreme Court to pause a ruling that would force it to overhaul its App Store policies. Google warned in a filing that without a delay, the company and its Android ecosystem will suffer irreparable harm. The move stems from its long-running antitrust fight with Fortnite maker Epic Games. Meanwhile, the Trump administration is weighing a plan to reduce reliance on foreign-made semiconductors. The Wall Street Journal reporting that the plan would require companies to eventually match imported chip volume with domestic production or face tariffs. Commerce Secretary Howard Lutnick has reportedly discussed the idea with industry executives. And as you and Annmarie have been discussing all morning, hedge fund manager David Einhorn is issuing caution on the massive waves of recent AI spending from big tech. The Greenlight Capital founder said the $1 trillion build-out by companies like Apple, Meta, and OpenAI is so extreme that the eventual returns are highly uncertain, going as far to say that the high spending may destroy vast amounts of capital. That's your Bloomberg Brief. Lisa.
Thank you so much, Yahaira. Up next, President Trump's tariff agenda.
We're doing well because of tariffs. We're doing unbelievable. We're making more money than we ever have made. We're going to take some of that tariff money that we made. We're going to give it to our farmers.
Former White House senior trade advisor Kellyanne Shaw joins us next. This is Bloomberg Surveillance. Good morning. Coming into a busy day of headlines from Washington, D.C., a relatively quiet day, except for in markets. We are all focused on what we get from core PCE out at 8:30 a.m. Eastern, about an hour and 15 minutes. Futures going nowhere right now, 6663 on S&P, basically flat. NASDAQ futures lower just a touch. Russell 2000 down 0.2% ahead of that key inflation print. Under surveillance this morning, President Trump's tariff agenda.
We're doing well because of tariffs. We're doing unbelievable. We're making more money than we ever have made. We're going to take some of that tariff money that we made. We're going to give it to our farmers, who are, for a little while, going to be hurt until it kicks in. The tariffs kick into their benefit.
Here's the latest. President Donald Trump announcing new industry-specific tariffs targeting pharmaceuticals, kitchen cabinets, and bathroom vanities, upholstered furniture, and heavy trucks. Bloomberg's Tyler Kendall joins us now. Tyler, what details do we know about these tariffs?
Yeah, hey, Lisa. Well, it's hard to know where to start. When it comes to pharmaceuticals, it does appear that investors at least are betting that any sort of exemptions are going to soften the blow. And that's because President Trump said that if you are manufacturing in the U.S. or have plans to break ground in the U.S., there will be an exemption. And we know that many of these drug makers already have manufacturing plants here. Also, probably worth mentioning that the EU had confirmed earlier this morning that the U.S.-EU trade deal will ultimately shield it from this higher 100% tariff, and we're going to see that 15% cap remain in place. Still, our analyst estimates that this could hit about $220 billion worth of U.S. pharmaceutical imports. When it comes to the other tariffs, these were, of course, also widely expected. The one trend line that we can pull from all of this is that they're all going to go into effect on October 1st. It's also going to be worth mentioning here that these were widely expected. We knew that these Section 232 investigations had already been implemented, that the administration was looking into what they think are these key industries, particularly when it comes to national security concerns. I will quickly add that when it comes to those heavy truck tariffs, this is an industry that's already been squeezed by the steel and aluminum tariffs. So we're going to be looking for any sort of carve out there as well. But Lisa and Annmarie, you both were talking about this morning. Perhaps we're getting a little bit of a glimpse into the timeline here because these Section 232 tariffs are considered to be a more durable legal basis, and the administration is currently gearing up for oral arguments in front of the Supreme Court on November 5th. We're getting closer to that date when it comes to the court challenge against the more broad-based tariffs enacted under IEEPA.
Tyler Kendall, thank you so much for that update. This person is the person I've been waiting to hear from all morning, former White House senior trade advisor Kellyanne Shaw, who joins us now. Kellyanne, thank you so much for being here. So what just happened?
Right. So a lot is the high level point. Right. So we have had 12 ongoing Section 232 investigations, and the president announced 2 more earlier this week into robotics and med devices. So the 3 that he seems to have announced last night, so on lumber, on pharmaceutical products, and the other one are really just like clearing the queue. So right now, he was under a deadline to get the lumber and timber 232 out. He has a 90-day clock from when that report went from Commerce to the White House. And we had been hearing that that report had gone to the White House technically either at the end of June or the beginning of July. So my assumption is that when they sat down to decide on the final measures, and he announced those for furniture products and upholstered furniture, that they also considered these other ones on top of that. So we saw the trucks and the pharmaceutical ones get announced as well. So a lot coming out at once, but these are things that are really about clearing the queue.
How much is this also about the administration preparing for IEEPA to potentially be struck down in the court so that they have a backup to make sure that they still have tariffs in place for a number of sectors?
So I think that's a good question, but I really question the merits of using a 232 strategy to make up for a potential loss of IEEPA tariffs, in part because they're product by product and sector by sector, whereas the president's current tariffs are really country by country. And so I think it creates this very messy patchwork. So we obviously don't know what the administration's backup plan is, other than they have one if they do lose. But I would suspect that it looks something more like a 301 strategy rather than a 232 strategy, but it could be part of that as well.
When you look at the tariffs that were announced last night, pharmaceuticals pretty much give this nod of like, if you're still investing in America or put something in the United States, you're going to get an exemption. Is that how you read it? So pretty much, is anyone going to be tariffed in terms of pharmaceutical space?
So this is really the big surprise for me. I was not expecting to see the pharma announcement today, in part because I did not get the sense that the administration had quite figured out this investment credit model. So this is the model that he's talked about, both in terms of pharma as well as for semiconductors.
Yeah.
So trucks, again, were ready for some time. I think that the furniture one was obviously ready for some time. But there's a real question as to how this pharmaceutical one is going to operate in practice. And what about producers who are already manufacturing in the United States but import some of their supply? Do they get a tariff credit as well? It doesn't seem like it from that tweet.
Which is interesting because the market's viewing this as a positive. It actually is not the worst case scenario for the pharmaceuticals. They're almost trading as though this is a relief. Do you think that that is validated by the actual framework?
Well, it does seem like generics are going to be carved out. So for some pharmaceutical producers, this is a real windfall. This is a boon. I think when it comes to the branded pharmaceutical products, the devil's going to be in the details, and we're not really going to know until we see that final measure, that proclamation. But we could also see this extended a bit further, meaning we've got this announcement of 100% tariff unless you're building in America. What does it mean to build? Commerce may have to issue regulations, so that might take a few more months before we actually see the final result.
There's so many details, and there's so many processes that have to go into place, not to even mention just collecting these tariffs and coming up with a way to do so and what the parameters are. To get this all done by October 1st seems like a tall task. Do you think it's feasible to get this all done and put it into effect in such a short turnaround?
Well, deadlines can move mountains when it comes to Washington, so there's certainly a chance. But what I would say is for trucks, you've got this 25% across the board tariff for finished trucks. We'll see what they do with parts, which the president didn't announce. For lumber, timber, furniture, it seems pretty clear what they're going to do. I think the pharmaceutical one is going to take a bit longer for them to really figure out how to find the way forward on that.
Are there any other 232s we should be looking out for, or is he done?
The president is never done when it comes to tariffs. Certainly the semiconductor one is one that's been on the books for a while. The president has announced it's going to be 2 weeks, 2 weeks, 2 weeks. So that actually could be 2 weeks from now. I also think critical minerals is one that is coming up. We've heard that they've made significant progress on the drone one as well. So there's a few more, and then a bunch in the hopper.
And how are you thinking about IEEPA?
So we'll have to see what the court does. I think that everyone's waiting for this final decision from the Supreme Court. But what's clear is the president's still relying on IEEPA for his tariff policy, like the tariffs on Brazil, and potentially others, like Russian oil tariffs we could continue to see. So I don't think the administration's done using IEEPA.
There's a bit of a contradiction here. A lot of the executives and the investors who we have on the show talk about how there's a greater degree of certainty, that we've seen peak uncertainty, and companies have a greater sense of what the framework of tariffs actually is. Do you think that that's appropriate, given that the president, in your words, is never done, and that we are seeing new proposals added on top of the ones that already have been announced?
Well, I think it's a matter of degree and comparison. So we have a lot more certainty than we did, say, back in April and May, where we really didn't know what the tariff rates were going to be on basically any product from any country, right? This was this mass negotiation. I told you to grab a beer.
And certainty, yes.
Exactly. So now we're starting to see this clearing of we have at least a 10 to 15% baseline for all countries. For some countries with elevated tariffs, those rates could come down. And then you've got sectoral tariffs where those rates are going to go up. So again, depending on the line of business you're in, the products you're importing, there could be big variations and big swings. But overall, the landscape does look much more clear.
I'm guessing you don't sleep much and that you get a lot of calls from a lot of clients saying, what is going on? What's their biggest concern right now? How high is their concern level about the uncertainty of what's to come and how to manage around it?
I think there's some uncertainty with the court case and what that might mean, and whether that means that there would be other types of tariff measures, what those would look like, the legal authority. I think there's some uncertainty in terms of the U.S.-China relationship, which is the big elephant in the room. We don't totally know how that's going to go and unfold. And then for countries where we have these huge tariffs like Brazil and India, we could see big swings there. But I think for companies that are largely transatlantic and some of these other more stable trading relationships, they're feeling less of that.
Let's end on China, because you're at the table for the phase one trade deal. What does the administration want to get out of this right now?
So right now we're in a tariff truce. It's not clear how far negotiations are going to go. I don't think there's an expectation of a broad phase two agreement. So it's really about managing the relationship, figuring out where we can trade, taking independent measures where we're not going to trade, which is largely going to be sensitive supply chains. And I think you heard from Besant earlier this week, it's about identifying mutual vulnerabilities. China clearly has a chokehold on the U.S. when it comes to rare earths and rare earth magnets. The U.S. is identifying aircraft engines and chemicals as potential chokeholds on China. So this is a dynamic relationship. I think it's more about maintaining the truce than making progress, but we'll have to see where this goes.
Former White House Senior Trade Advisor Kellyanne Shaw, thank you so much. We could spend an hour with you trying to figure out what's going on, and it's very helpful to understand what the moving parts are. It's a process, as you've said many times before.
It feels like treading water, though, when it comes to the U.S.-China relationship. This basically figuring out who has what leverage and where. there and not wanting to poke too far.
Yeah, and it's going to be a tit for tat that will go on for longer rather than resume in short order. Coming up next, Richmond Fed President Tom Barkin as the central bank shows signs of division. Plus, Danny Berger with your morning movers. To end the week on a high note, not necessarily just with mood, but also with futures. Futures trying to climb into the positive area, at least for the S&P. For the Russell and NASDAQ, futures are lower, but back from some of the earlier losses. Russell 2000 lower 0.2% because of the story in the bond space. Do we see a surprise to the upside in inflation that ties the Fed's hands when it comes to how much they can cut rates? 2 hours away from the cash open, here are your morning movers with Danny Berger. Danny.
Hey, Lisa, the winners in today's trade are the domestic chip manufacturers, with the Wall Street Journal story saying that the Trump administration plans to press companies and unveil a plan that would force them, or at least encourage them, to buy more chips from Intel, Global Foundries, those made in the U.S. You can see the rally underway for both those, up 4.3% for Intel. Global Foundries goes up 10.5%. A similar story unfolding in pharma. You were talking about this just moments ago. This idea that you would get 100% tariffs from the Trump administration on patented drugs, unless you are building factories in the U.S. So we've seen plans from Eli Lilly, for example, and Merck to build those factories in the U.S. So Eli Lilly, Merck, AbbVie, all of those shares moving higher by around 1% this morning. Meanwhile, Costco, they reported earnings after the bell yesterday. You're looking at a 2-day chart of Costco for some reason. In the morning's trade, it is slightly higher. They beat on basically all the metrics. There's some nerves around Costco when it comes to things like tariffs. They did say they were going to take steps to try to mitigate that. They would consolidate some of their purchases and try to look for locally sourced inventory. But they did say that they're going to concentrate their holiday season on more value and essential-oriented products, just giving you a taste of where the consumer stands, Lisa.
The choiceful consumer, as we keep hearing about. Danny, thank you so much for that. On our radar this morning, President Trump announcing new tariffs on pharmaceuticals, heavy trucks, and furniture imports effective October 1st. Companies would see 100% levies on patented drugs unless, and there's a pretty big unless, they are building a manufacturing plant in the U.S. Meanwhile, President Trump signing an executive order declaring the plan for American investors to buy TikTok's U.S. operations complies with national security requirements. Officials setting up a potential value for the social media app at $14 billion. Annmarie, it seems like the president's really busy right now between brokering a deal with TikTok and potentially putting new tariffs on. What I'm struck by is that all of these things are working at the same time that the Supreme Court is potentially going to overrule the IEEPA tariffs. What do you think the market's reaction would be to that?
Well, this is a good question, because this also could be why Trump is coming out with more of these sectoral tariffs. And then to Kellyanne's point, he might have to do 301s as well, not just 232s. Because what if the court does say that using IEEPA is illegal? What happens to all these billions of dollars the administration is touting that's coming in to potentially bring the deficit down? I think the market then is going to question the credibility of all the policies. If this policy that all these negotiations with all these countries are surrounding upon is illegal, then what else potentially is illegal and might never actually come to fruition?
And from a market perspective, the idea of not getting the $4 trillion of revenue over 10 years would really change the backdrop for long end of the yield curve. The idea that yields have rallied on the heels of that potential income. What happens if that gets removed or has to get paid back?
Well, this is the Treasury Secretary's entire point as well. This is impacting even current negotiations as well, and it's going to impact this money that's being brought into the United States, to your point, what it's doing to the bond market. And then I think the market just takes a step back and just looks at saying, now I have real policy uncertainty, because every single policy that comes out, do I just feel numb and look through it? Is it even going to happen? Or do I need to actually take it as a tangible risk?
Adding to policy uncertainty, a Dallas Fed President Lori Logan saying the central bank should replace its benchmark federal funds rate. Logan arguing the Fed funds target is outdated and suggested the TGCR, a more widely used market bellwether that she says could offer the most benefits. A fascinating story that a lot of market participants have been arguing for a long time, the idea of a tri-party collateral system, that being something that is more accurate and has a much higher degree of volume on any given day. Sticking with the Fed, we are just under an hour away from fresh inflation data. Bloomberg's Michael McKee joins us from Washington with a very special guest. Mike, I'll throw it to you.
Well, thank you very much. Joining us this morning, Richmond Fed President Tom Barkin here on Bloomberg Television and radio worldwide. And on radio, they can't see it, but on television, people can see you have a bit of a bandage on your head. You just had one of those older people's kind of operations.
Yeah, there's no truth that it was what happened in the last meeting.
All right. Speaking of the last meeting, we came out of that believing that, or at least Wall Street, that you're going to cut rates again in October and maybe in December. But since then, we've gotten some numbers that show GDP is hotter, inflation is still running hot, and the jobless claims numbers suggest companies aren't laying anybody off. So should we have less confidence in the path going forward?
Well, I don't think you can mark to market the next meeting every week, even though that's what the markets do. I mean, let's see what happens on the unemployment side. We'll get some important data in a couple minutes here on the inflation side, and I think we'll get there when we get there.
Well, the majority seem to believe, at least according to what the chairman tells us, that inflation is going to be a one-time rise in the price level. Then overnight, we got a bunch of new tariffs, as you just saw, on a lot of different things from the president. How much confidence do you have in any kind of inflation forecast at this point?
Not much. I mean, what I definitely see happening is there are cost increases that suppliers want to pass on. There's no question about that. And tariffs are a big part of it. But you could put health insurance and other places, other costs in there, too. But those costs are going to attempt to get passed on to a consumer who's frankly exhausted of price increases. And so, we're seeing a lot of trading down, branded to private label kind of choices. But we're also seeing people trade off. And it wouldn't surprise me at all if people who are forced to accept certain price increases, therefore don't buy something else on the other side. And that's your classic relative price trade-off. And that may mean that you won't see as much broad-based inflationary impact as you'd see, price increases on particular items. We'll see.
And yet you get PCE in an hour, and basically you've already calculated the numbers. Inflation's not moving in the right direction. So can you still justify, or how long can you justify cutting rates in that environment?
Well, we have inflation moving in the wrong direction. Unfortunately, we also have unemployment moving in the wrong direction. And that was the backdrop of the last meeting. You have to ask yourself, how are the risks still the same as you saw them 2, 3, 4 months earlier when you had unemployment in the right direction and inflation in the wrong direction? My overall thesis, though, is that while it's not, ticking in the right place, the downside is relatively limited. I see the inflation downside is limited by this customer pushback that I just talked about. Also productivity, which I think is, we're seeing that at real scale. And so that means there's less pressure to pass costs on. And then on the unemployment side, obviously labor supply is dropping at the same time as labor demand. And that's keeping the unemployment rate, relatively balanced. And that's the combination of immigration and revocation of temporary status. Also, our generation, Mike, which is leaving the workforce. I mean, you're seeing 1.3 million more people over 65 out of the workforce every year. And so you've got less labor demand, low hiring, low firing environment, but you've also got less labor supply. And that probably means that the unemployment rate increases are going to be relatively limited.
Well, at least you and I are still employed as of today.
We'll see how this interview goes from there.
You've suggested that companies in your district are beginning to feel a little bit better, or at least some of the uncertainty has come off of their planning and their thinking. Are these kind of big new tariffs that we got today just going to change that mind? Has that the idea that ongoing tariffs and ongoing disruption are going to be part of this administration and economy? Is that in their planning?
Well, I've been describing it as a fog that's created uncertainty. And I definitely think in the context of the last couple of months, the fog has started to lift. Businesses don't know exactly what the tariff will be on their sector necessarily, but they kind of have a sense of the range. People aren't really following the news every day, the same way they were back in April. And a lot of businesses I talk to say, look, I've just got to do something. I've got to take action. I can't be on the sidelines forever. So I am seeing people more in the game. Now, if you're in a particular sector where you see a new announcement, of course, that's going to set you back. And so, what I say about businesses in general is not true of businesses in every sector. And so there's sectors with a lot more clarity and sectors with a lot less clarity. And that's, I think, just going to be part of the game here.
This morning we had an investor on who basically said markets are rising because of the idea that a year from now rates will be substantially lower. Is that the right way to look at it, the wrong way to look at it?
Oh, I wouldn't know how to think about, how markets ought to rise or not rise. I mean, we're very much focused on trying to land the plane here and balancing inflation, unemployment. As I said, I think both of them have ticked in the wrong direction, but on the other hand, the downside is limited, and we're just going to have to, adjust our stance as we learn more.
Well, where's your dot? What are you thinking in terms of the next couple of meetings and then for 2026?
Well, I really like the dot process for me because it forces real integration of your thinking in terms of where you think the economy is going, where you think policy is going. But I don't have it as a forecast prediction. It's not, something I like to talk about publicly because it adjusts. We do mark that dot to market as things go. So, every meeting for me is one where I want to stop and look at the balance between how we're doing on the inflation side and the unemployment side and make the right decision.
Well, the story around the Fed this week has been, shall we say, the debate over where the neutral rate is. Where do you think it is, and how fast would you want to get there?
Well, I've seen a lot of the stuff that's been in the press, and we're studying that. And, I always try to understand all arguments and figure out how to integrate them into my thinking. I'd point you to the Richmond Fed neutral rate, the Lubric-Mathis model. It takes a lot of signal from what you see in the real economy. And in the real economy, over the last couple of years, what you've seen is interest rates go up and the economy stay relatively healthy. And so that model has a relatively high neutral rate because it takes a lot of signal from the current environment. Now things can change, but that's where the Richmond Fed model is right now, and I'd point you to that.
What number do they have? Where are you?
It moves around based on what's happening in the economy.
Well, that gets to the next question. Is Chairman Powell saying that you really don't want to target the neutral rate because it moves around? Also saying that for any voter to really move things around, you have to be incredibly persuasive. Do you find Stephen Miron's arguments persuasive?
Well, I'm looking forward to digging into them with my team, and I like every voice in the room. And every argument in the room, that's what we do as a discipline, is we sit down and try to take those arguments apart and figure out which parts of them really resonate with the way we think about things and which parts don't. And we're looking forward to doing that.
Is it neutral?
On the neutral rate, in general, I just want to agree, it's not that useful as a operational tool. The models out there, even the one that I talked about, have a confidence interval of about 200 basis points. And so you could say it's 3, which is around the SEP median. You could say it's 3.5 or 2.5. But if you add a 200 basis point range to it, you say that's not that helpful for making operational decisions on monetary policy. What is more helpful, and the reason I favor the model we've got in Richmond, is how are you seeing the economy react real time to the level of rates you've got in the market? And if you see it weakening, that's a signal that maybe you've got it too high. If you see it relatively strong, that's a signal the other way.
Lori Logan went to Richmond to announce her idea of changing the operational rate for the Fed. What do you think of that?
Well, I appreciate Lori making the trip. We had a balance sheet conference yesterday that was very well attended, and I thought lots of thoughtful papers, including hers. And I thought she made an extremely articulate, well-reasoned argument, and I'm looking forward to digging into it further.
You anticipate the Fed making a change?
Oh, I don't know.
The Supreme Court, if it allows the president to fire Lisa Cook, what does that mean for the Fed?
Well, the judicial processes and political processes will operate however they operate. What I do every day is show up and try to argue for the best monetary policy we can and make the case, as you said, in a persuasive way to my colleagues. And that's what I'm going to continue to do.
Well, let's leave it with this. What is the best monetary policy right now? Continued rate cuts, or do you not know at this point?
I think you have to be very adaptive to what's playing out here. The world I've described is one where the labor market is weakening. It's a low hiring environment, but the labor supply is also short. And you have to be very attentive to that balance because it could get out of balance, right? Similarly, on the inflation side, you do have these cost pressures and 4.5 years of inflation over target. On the other hand, you're not seeing that show up in spikes in inflation in the real-time numbers. We are seeing what seems to be a productivity boom. And so I think you have to be very attentive to how little we know about how each of our mandate variables is going to play out. And so, I feel like very adaptive is the way to think about it, and that's part of why I'm not being prescriptive into, it's this many cuts over this period of time, because I think we're going to see and learn a lot as we go here.
Tom Barkin, thank you very much for coming up to Washington and joining us this morning here on Bloomberg. We're going to send it back to you.
Bloomberg's Michael McKee, thank you so much. Wonderful interview with Tom Barkin, the head of the Richmond Fed, with a very adaptive posture. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Anand. Yahaira.
Hi, Lisa. European diplomats warned the Kremlin that NATO is ready to shoot down any Russian fighter jets that violate their airspace. Sources telling us here at Bloomberg that British, French, and German envoys issued the warning in a closed-door meeting in Moscow. The move comes after 3 Russian fighter jets entered Estonian airspace last week, a claim Russia denies. Meanwhile, Boeing shares are slightly higher in the pre-market, up 0.75% after the plane maker landed one of its biggest deals of the year. Turkish Airlines has agreed to buy as many as 225 Boeing jets in a deal that could exceed $22 billion. The accord followed the bilateral meeting between Turkish President Recep Tayyip Erdogan and President Donald Trump. And a Chicago court has ruled in favor of United Airlines over valuable gate space at the city's O'Hare International Airport. United's rival American Airlines had requested to block United from expanding at the airport, which is the only dual hub facility in the country. The judge ruled that American failed to show it would suffer harm from the reallocation of gates. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. But are they going to upgrade O'Hare? I'm sorry. I actually feel very strongly about this, having spent a lot of time in Chicago.
This is personal.
It always ends up being a little bit personal. Up next, weighing risks to the economy.
My view is not one of enormous economic pessimism. I don't think the economy is about to crater. I don't think the labor market's about to fall off a cliff. However, the neutral rate is drifting down.
Winnie, Cisar of CreditSights joining us next. This is Bloomberg Surveillance. Feeling a little more positive as we get closer to the open. Right now, we are looking at a bit of gains across the board, except for the Russell 2000, still pegged to this potential inflation print that we get in about 45 minutes time. Elsewhere, just seeing some of the session highs, even with some of the concerns out there from tariffs to economic sluggishness. Under surveillance this morning, weighing risks to the economy.
My view is not one of enormous economic pessimism. I don't think the economy is about to crater. I don't think the labor market's about to fall off a cliff. However, the neutral rate is drifting down. And as a result of that, it's incumbent upon policy to adjust in response. And the longer that policy stays excessively restrictive, the greater the risks to the downside for the economy.
Here's the latest. Fed Governor Myron highlighting risks to the economy if the Fed doesn't move quickly to cut rates. With less than an hour until that core PCE print is released, Winnie, Cisar of CreditSights writes the following. If payrolls continue to come in around recent levels, we see the U.S. unemployment rate rising to 4.5% by year end, which would mark the highest level ex-pandemic since 2017. Winnie joins us now. Winnie, great to see you. Thank you for being with us. There are these two risks to the economy right now, a potential reacceleration that could prompt inflation to run hot, or some sort of deterioration, which has a lot of people concerned as they look at the labor market and some of the recent payrolls reports. You're on the more cautious side about the economy. Why?
Good morning, Lisa. We are on the more cautious side, and I think that a lot of it comes down to seeing that the consumer feels like they are running out of steam, while at the same time, corporations, small businesses are facing a wide mix of pressures that are going to make margin expansion gains much harder to come by and probably put incremental pressure on margins. And when we put those things together, it likely will lead to continued softness in the labor market and continued softness in consumer spending and expectations. And that's where you get into a really challenging cycle overall.
Well, this is a challenging cycle because some people are spending and some people aren't. And the people who can spend are the ones propping up the spending reports that we're probably going to get in about 40 minutes time. At the same time that you get CarMax reporting earnings and highlighting a deteriorating credit backdrop for lower income individuals and people looking to buy cars. Why are you more focused on the CarMaxes of the world and less on the high flyers, the luxury flyers, and say United?
Yeah, that's a great point. And that bifurcation in terms of the type of consumer spending has really been something that we've been focused on for many, many years. But I think the big takeaway is if we are continuing to get contraction in some of the lower income, middle tier consumers, there is the risk that that continues to kind of leak up the income spectrum. And at the same time, as we're thinking about how companies are going to be managing margins, we do have some concerns about some of those higher income jobs being at risk. And then when you factor in also some of the relative softness that we've seen in the housing market as of late, those mix of factors make us a little bit more cautious on the consumer as a whole relative to those segments of consumer that have been weaker or stronger.
But Winnie, looking at the unemployment rate, 4.5%, how difficult might it actually get to ticking up to that, given the fact that there is also a supply issue when it comes to the labor market, the fact that it's dwindling?
Yeah, this is a great point. And when you run the math, if we had a labor participation rate that currently was the same as the beginning of the year, it's fallen over the course of the year, we'd actually be around a 5% unemployment rate already. So that supply side labor dynamic has been really impactful in terms of unemployment overall. You know, Feds of years past would have seen 4.5% on the unemployment rate and been celebrating or cheering, whereas you have to think about, okay, we have an aging economy, we have some demographic headwinds relative to people retiring and dropping out of the workforce, we have immigration policies that are changing quite significantly. And as we think about the unemployment rates, you know, that's just one factor. If we have fewer people in the labor market who are, you know, kind of productively contributing to the economy, that also has some impact and a domino effect on things like spending and consumption. So all of these things are very related, and it's important to not just put too much stock in that one. You know, 4.5% is not a terrible level in a long-term historic perspective.
You need the context around it in order to really understand why that 4.5% is actually worrying. So what do you expect the Fed to do with all of this?
Now, the Fed is in a sticky spot, right? And I think as it relates to markets want policy stability and they want policy clarity. What we've seen over the past couple of years is as the Fed is kind of preparing to cut rates, markets are really strong, right? They like that stability of policy, the relative low volatility environment for rates and also equities is very supportive overall to markets. So I think if the Fed just kind of continues to sit on their hands and message a expectation that, you know, we're ready to continue to ease policy, if the data are within that realm of it is appropriate to ease policy, markets are going to react favorably to that, mostly because of the technical. Now, where we get worried is the longer you wait, that increases the risk that the economy is going to break one way or another, because the aggregated data do tend to mask some very specific trends that are lingering below the surface that could be more detrimental or more positive as well.
Winnie, Cisar of CreditSights, thank you so much. It is a complicated moment and one that we will continue to analyze. Look forward to speaking to you again. Right now in markets, you can see people analyzing it saying, well, maybe this is a buyable dip because ultimately it seems as though the AI cycle is one unto itself. Coming up next as we head to that core CPE print, Victoria Fernandez of Crossmark, Greek Prime Minister Kyriakos Mitsotaki, former St. Louis Fed President Jim Bullard, and Ryan Wang of HSBC. This is Bloomberg Surveillance.
We think inflation is going to continue to move lower once we get past this little bump related to tariffs.
The pass-through of the tariffs into inflation has just been a lot slower than what I'd expected.
Tariffs are going to increase prices.
I don't think that we should be pulling our hair out that inflation is about to take off again.
If inflation starts accelerating, I mean, you can't rule out that they skip December.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. 30 minutes away from key inflation data. We get core PCE income and spending coming out in about 20 9 minutes time. The market may be shrugging off what's going on in Washington, D.C. with more tariffs being announced and a potential shutdown. But traders are hinging on every hint of what a cutting cycle could look like from the Federal Reserve, with really inflation front and center in terms of how much Annmarie is going to tie the hands of Fed officials.
But I still come back to what Powell said at Jackson Hole and reiterated again this week, the fact that we might have one-time price adjustments, but they might not be all at once. Basically, is he giving everyone the green light just to look through, even if today we get a hotter PCE print?
So the way it's going to go today is we get that core PCE print as well as spending, personal spending. How much does that continue running hot, especially given what we saw yesterday in terms of personal consumption with the GDP and how much that drove an upgrade to what we saw in recent months. We're also going to be getting University of Michigan sentiment survey, which will be interesting. And I know you can say it's got some hair on it, but it speaks to this question of how much are consumers starting to increase their inflation expectations. And then we're also going to hear from Mickey Bowman on the Federal Reserve. I think you're right, Annmarie, to bring up this idea. What's the reaction function from the Fed? We don't know. We don't know how far they're willing to look through this. But right now, after seeing a heavy one-way trade of yields downward, we have seen them creep a little bit higher ahead of what could be just a little bit more of a hot print.
But we just heard from Richmond Fed President Barkin. Tom Barkin talking about really only limited risk of further deterioration on both fronts, and that they're just now trying to basically land this plane. He didn't seem that concerned. And when Mike McKee kept asking about, are you concerned about the tariffs? He said broadly, the tariff fog has lifted and companies have more direction. At the same time, just hours ago, the President of the United States unleashed a slew of new 232 tariffs when it comes to a number of different sectors in the United States. So it is really difficult to see how actually the fog has lifted. Maybe writ large, we have the direction of travel and there's an understanding from companies in the markets. But as Kellyanne Shaw said, the president's never going to be done with tariffs.
Well, the fog has lifted, at least for stock traders, as you see, heading into the open. A little bit more of a positive tilt across the board. S&P futures have been flat all morning, clawing back from some earlier losses. NASDAQ also has been clawing back. Near session highs now on both fronts. S&P futures up about 0.1%. Meanwhile, what we are seeing is dollar strength, at least yesterday and the day before. Today, a bit of euro strength as it really toggles around this 116 level. A question of how much the sort of one-way weak dollar trade will get reversed if we do get ongoing strong data that questions just how far the Fed can cut. And yields just marginally lower with the 10-year 4.16%. Again, not a lot of concern about the Fed losing enough credibility that could lead to some sort of runaway inflation. Coming up this hour, Victoria Fernandez of Crossmark as stocks look to get back on track. The Prime Minister of Greece, don't miss this, Kyriakos Mitsotaki, as the UN General Assembly is winding down, and former Fed President Jim Bullard as we break down the latest inflation data. We begin this hour with stocks looking to snap a three-day losing streak. Victoria Fernandez of Crossmark writing, sentiment is leaning toward an extreme level, but we aren't there yet and anticipate markets moving higher in the near term. Victoria joins us now. Victoria, we had 3 straight days of losses. Keller, is this a buy the dip moment?
It seems like every pullback has been a buy the dip moment this year. And I think this is probably a good opportunity as well, but not across the board because we've lost some of that underlying momentum in the equity market. So I don't think you can just go in and say, let me buy everything. But I do think there's sectors that where you can be opportunistic, where you're seeing some of those really strong trends. Those are tech, it's financials, you're seeing it in industrials. You're just starting to see a trend. Strength in energy. I wouldn't say go in and buy yet, but watch that. That could be a place where you could add. But the defensive part of the market, the staples, the healthcare, they just continue to do poorly. So I'm not sure I would add there, but there are some opportunities.
Victoria, how much do you lean into this idea of a K-shaped recovery, or as Peter Scheer called it, an I-shaped recovery with the dot on top and everything else on the bottom? This idea that personal spending is hanging in there, but largely because of the upper 10% of income earners, and that they keep spending even as you see spending power in the lower income brackets really deteriorate. How much can you just sort of concentrate your investments, putting aside social implications, et cetera, on areas that benefit from that while fading into some of the areas more leveraged to everything else?
Yeah, Lisa, I don't think you can look at it exclusively from the consumer. Yes, the consumer drives the economy, but there's a lot of nuances. You were talking with the previous guest about the bifurcation between the higher income earner and the lower income earner. What's interesting is, yes, higher income earners right now are still spending because the stock market's high, because housing prices are high. But remember, come spring of next year, we have about $150 billion of additional stimulus coming from tax credits, child tax credit, the SALT deduction will be adjusted. The standard deduction is being adjusted. That's a lot of stimulus coming in that's going to benefit the lower income consumer. And they are more willing to spend their additional dollar than the high income consumer who actually saves a lot of those additional dollars that comes in. So I think what it does is it stretches out this timeline where we're going to see consumption continue to do well in the near term because high income consumers are doing well because corporations are not firing as much as a lot of people anticipated. It's the holiday season. Then we've got the stimulus coming in next year. So I think there's a lot of elements here that can serve as tailwinds to the consumer. But once all that evaporates, we have to wonder where we'll be. And that's the part that makes us a little nervous.
Well, Victoria, also the president overnight announced more tariff rates. At the same time, we just heard from the Fed's Barkin, who says that the consumers are exhausted by price increases. Do corporations have the power to continuously pass on price increases to the U.S. consumer?
Yeah, Annmarie, it's interesting because we haven't seen those prices flow through to consumers as much as we anticipated we would, but yet you're not seeing margins compress for these corporations. Look at margins expectations for the next quarter, this earnings season, 14%. So if margins are holding up, then I think corporations are okay to hold prices somewhat level. Will they increase a little bit? Probably. But I think a lot of that has to do with the fact also that we haven't seen a lot of the more expensive inventory come in yet. So maybe that cost of goods sold goes up over the next couple of quarters, and then we start to see the adjustment on the corporate side. And I don't think they're going to be able to push all of that pricing through to the consumer. That's when the consumer says, we're done, we're pulling back.
There's also this question about whether policy is legal or not. The court is still going to decide on whether or not the president can use IEEPA to enact the broad-based tariffs when it comes to countries. Lisa was asking a great point earlier. How is the market going to react if the Supreme Court says using IEEPA is illegal?
I was reading an article yesterday, and they had a great line that said the Supreme Court is not deciding if tariffs are going to be put in place, but how they're going to be put in place, because the administration already has backup plans lined up in order to put tariffs back in place. Section 232, those are legal. That's what we saw last night with some of those elements coming in. And some of the other ways that the administration could put tariffs in gives you a 10-15% limit on tariffs, which is kind of where we ended up for a lot of countries anyway. And I think that might have been part of the plan for this administration, knowing that they could get a negative reaction from the Supreme Court on this. So there could be some volatility in the markets around it, but I think looking out, tariffs will probably remain, but there might be some volatility in regards to how they get implemented. I don't think we're going to have to see a large amount of refunds go out. I think the Supreme Court realizes that would be quite detrimental to the economy.
Before we let you go, Victoria, this used to be a really data-dependent market that hinged on every potential move from the Fed, as much as fretting about what happened in Washington and D.C. and then deciding to ignore it. I'm just wondering, about 20 minutes away from that core PCE print, where do you think the bias is in terms of markets right now? How offsides could it be if there is an upside or downside surprise?
I think it really depends on the magnitude of the offside. If it's just a little bit, a tenth or so, I don't think the market frets too much. They believe the Fed's going to continue to lower rates, and that's what they're moving forward with. If it's a larger upside surprise, then I think the market starts to worry and say, wait a minute, maybe we don't get 2 more cuts, which I don't think we get this year anyway, but maybe it also affects what we're looking at for 2026 and where that neutral rate's going to be. So I think it would have to be a pretty large difference for the market to really have a strong reaction.
Victoria Fernandez of Crossmark, thank you so much for that. Have a wonderful weekend. Right now, I do want to bring to you some news. Boeing is supposedly getting the FAA okay to do final safety checks on the 737 MAX. This being reported, Annmarie, by the Wall Street Journal.
Yeah, and then that would mean lifting the cap on Boeing 737 MAX production, easing those restrictions from the FAA. And we saw immediate move in Boeing. This is a huge sign of relief for the company, for management, and of course the stock now up more than 3% this morning.
Yeah, we'll be following that with a vote of confidence from a lot of the airlines as well in terms of getting their production back online. Right now, let's get you an update on stories elsewhere this morning with your Bloomberg brief. President Trump announcing a fresh round of tariffs. The administration is imposing a 100% tariff on name brand pharmaceuticals. That is effective October 1st, unless producers build manufacturing plants in the United States. New duties will also hit imported heavy trucks and furniture. President Trump promising not to allow Israel to annex the West Bank. When asked about Israeli leaders suggesting seizing control of parts of the territory, Trump saying, quote, "It's not going to happen." This comes ahead of Prime Minister Benjamin Netanyahu's visit to the United States next week. And lawyers for Fed Governor Lisa Cook asked the Supreme Court not to allow President Trump to immediately remove her, saying the move would, quote, "sound the death knell for the central bank independence." The administration has asked the court to permit the president to remove Cook while litigation continues over the legality of her firing. That is your Bloomberg brief. Up next, the Prime Minister of Greece, Kyriakos Mitsotaki, as the UN General Assembly is winding down. Do not miss that conversation. This is Bloomberg Surveillance. Good morning. Welcome back to Bloomberg Surveillance. Right now, markets trying to claw back after 3 straight days of losses. A bit of a lift in the S&P and the NASDAQ. A really important conversation. Let's get right to it. Bloomberg News editor-in-chief John Micklethwait is standing by with a very special guest. John, I'll send it to you.
Lisa, thank you very much. We have Kyriakos Mitsotakis, Prime Minister of Greece, here with us. We'll jump straight in. A lot of movement on Ukraine this week. You've had Trump saying stuff about it. You have various NATO allies getting cross about the fighter jets incursioning into their territory and warning Russia about it. You even had Germany coming forward and saying, let's use the 140 billion euro frozen assets to help Ukraine. Now, you have always been a kind of champion of this idea of having a common European fund for defence. And you've always had pushback from the Germans on that. Do you think now it stands a chance of going through?
Well, thanks for having me, John. I've been advocating for quite some time about the need to create some joint European borrowing facility to cover what I consider the quintessential European public good, which is common European defence. And I do sense that there is much more momentum now amongst my colleagues. Some of the countries that were inherently against the idea of additional further joint borrowing have changed their mind. And I'm pretty sure that Germany will eventually also agree to this necessity. And we need to make sure that this facility finances projects of common interest. And I would put missile defense, drone defense right up there in terms of our collective European priorities. So I would expect some movement soon. We have 2 European councils, and hopefully we can make progress towards that direction.
Just looking at the economy at the moment, the Greek economy has been doing very well, as no doubt you will tell me, but in 2024, you forecast a deficit, and then you ended up with a surplus. And this year, you're again forecasting a deficit, but it's quite close to the end of the year. I wondered if now you're close enough to say this year you'll end up with a surplus again for the government.
Well, we've been producing significant primary surpluses, and I think it's quite possible that we may have a real surplus again this year. This is a foundation of our economic policy. We've suffered a lot from not being fiscally disciplined. This is not going to happen again. But I think the big success of our policy is to ensure that the economy is growing at the same time, to create jobs. We've created 500,000 jobs since I became Prime Minister. And the real goal is to ensure that this collective wealth is spread equally. So my focus now is to use whatever fiscal space I can create through growth and tackling tax evasion to cut taxes for the middle class. It's important for me that this discussion is not just limited to the economists saying good things about the economy. I want the average Greek to really feel a tangible benefit from this growth story. And starting January 1st, when these tax cuts will kick in, they will see a real increase in their paychecks, and this is very, very important to me.
Just come back to the average Greek in a second. You just mentioned fiscal discipline. I mean, you look at the core of Europe. I sat down with Prime Minister Sanchez of Spain the other day as well. Something dramatic has changed. You know, Greece, Spain, you're the countries growing really fast. In the middle, you've got countries in much greater trouble. You look at France, you're growing at over 2%. They're struggling to get to 0.5% of growth. Their debt is ballooning. Are we now in a situation where you would worry about financial contagion from France?
This seemed inconceivable a few years ago. What I can tell you is that eventually no one can beat the markets. We know this very, very well. And I do think that at some point governments have to take difficult decisions to put their fiscal house in order. We've done that. Once you do it, then you can enter into this virtuous cycle where you can actually grow the economy, you can cut taxes, you can support income through targeted measures. We are there, but we also went through very, very difficult periods and very painful reforms. So I do hope that the political situation in France somehow stabilizes. It is important that the core of Europe, France, Germany, that these economies are doing well. Look at, we will receive 36 million tourists this year. Our tourism industry is booming, but if our core markets don't do well, we will also at some point indirectly be affected.
You're a famously polite man, and I know that Schadenfreude is not a Greek word, it's a German one, but there must be some element in Greece of looking at these people who nearly pushed Greece out and thinking, well, things have changed.
Well, things have changed, but at the end of the day, this is not about pointing fingers or about saying that you were wrong and we were right. It's about ensuring that Europe collectively grows. I'm disappointed by the fact that when I look at the Draghi report, we have not made significant progress. And I think it's time that in Europe we usually wear two hats at the Council. We wear our European hat and we wear our national hat. And it seems to me that for some countries the European hat seems to be shrinking. So we have to look at the big picture. Some of the decisions that we need to take require more funding. It's pretty clear. And we need to put our European interest not necessarily ahead of our national interest, but to realize that some difficult decisions need to be taken at the European level.
One of the areas where Europe has been pretty useless at doing these things is banking, the banking union and things like that. Italy's UniCredit has built up a stake in Alpha Bank, which you were famously much more relaxed about than the Germans were when they built up one in Commerzbank. Would you be prepared if they were to take over Alpha Bank? Would you be relaxed about that?
If we really mean what we say about creating scale in banking union, we should be open to these types of transactions. I see value when an important foreign bank wants to acquire a stake in a Greek bank. It means they believe in the potential of the Greek economy. And it means that the bank could possibly do better. I'm pushing my banks to extend more credit to mortgages, to small, medium-sized enterprises. The stronger their balance sheet is, the more likely it is that they will do. So yes, in principle, we are in favor of these transactions. And I'm happy that UniCredit has decided to look at one of our Greek banks and take a significant stake.
Isn't that, but as you said earlier, that's the kind of problem with Europe at the moment. Most people are taking these decisions on, I suppose, purely nationalist or that kind of level. You look around Europe at the moment, the ability to create common things like a banking union, that's the real problem at the moment. Yeah. Do you think that is something coming from Brussels or from the national capitals?
I think most of the important, if you want to understand what's happening in Brussels, look at the national capitals. I think the Council has become more complicated in terms of taking decisions. But on the other hand, in the past, we took a momentous decision when we had to address COVID. Is Ukraine a geopolitical COVID moment? I would argue to a certain extent, yes. And I remember the COVID fund negotiations. There were a lot of countries, including Germany, that said no until they said yes. So when it comes to defense, which, as I said, is the ultimate European public good, I do expect that we will be able to take important decisions to target specific European projects, which would then again require European collaboration.
You talked a bit earlier about the average Greek. I was looking at the numbers. Greek GDP has come soaring back, but it's still roughly the same level in nominal terms as it was before the crisis, a bit lower in real terms. Is that still, do you think Greece has now been through that phase and it's now the terms of looking forward to a different form of Greece?
We have clearly turned the page. But as I said, if we want to converge with Europe, we need to grow faster than Europe. We've been doing this, but this growth needs to be qualitatively different. It needs to focus on investment, on innovation, on exports, on creating really valuable jobs. And my main goal is to ensure that wages increase, that we have wage convergence with Europe, and that we support disposable income at a time when all European economies are faced with a cost of living crisis. And the only way to address this is to ensure that we support disposable income, but we have to do it in a fiscally sustainable way. That's what we have done so far. We will continue doing it. I do expect that next year we will again, perform very well. So I tell my fellow Greek citizens that I think the best days are ahead of us and that this is a policy that will deliver long-term benefits to them.
You have elections coming up in 2027. The polls at the moment say you might have to go into coalition with people. You've won 2 terms. I think you'd be the first person to get a third term if you did. Would you be prepared to go into coalition if it reached that?
Elections are 18 months ahead, 18 months out. We are way ahead in the polls. Our goal is to win an absolute majority. We've done it twice. There were people doubting that we would succeed before the previous elections. I think that if we deliver on our commitments, and if the economy continues growing, if we work hard to improve the National Health Service, these are the priorities I set out in 2023, we have a reasonable chance to win an absolute majority. But if the Greek people decide otherwise, eventually we have to respect their decision.
We will look forward to following you through that. Kyriakos Mitsotaki, thank you very much for talking to Bloomberg.
Thank you. Thank you, John, for having me.
Bloomberg News Editor-in-Chief John Micklethwaite, thank you so much for that terrific interview with the Greek Prime Minister Kyriakos Mitsotakis, talking, and really to me this stood out, Annmarie, the idea that for several years running, the Greek government has said that they are going to end the year with a deficit, and each year they were sandbagging, and they ended with a budget surplus. And what the Prime Minister just said there is it's highly likely that they will once again this year.
Isn't it so interesting, too, also how the tables have turned a lot in Europe since the debt crisis, and it was the periphery that was really on the back and struggling. But actually what we've seen is there's been a tremendous amount of investment, tourism, actually going to the periphery, and really the big issue right now in Europe is China coming in and hollowing out the industrial base. And most notably, that is happening in Germany.
Yeah, and that is a story that we will continue to follow. We are just minutes away from the latest round of PCE data, which is set to cross core PCE plus personal income and spending. A real question here about whether that will hamper some of the Fed's ability to cut rates more aggressively. We'll also be speaking with former Fed President Jim Bullard to discuss what we just saw. That's coming up next. Right now, markets getting a bit of a bid after 3 straight days of declines, trying to break that. Do you get a sense of some sort of push? This idea that inflation is coming in just enough to give the Fed the green light to go ahead 2 more times this year. This is Bloomberg. Less than 30 seconds away from a core PCE reading. We are expecting an increase of 0.2%, which is below where we were the previous month of 0.3%. We're also going to be getting personal income, personal spending heading into that. Stocks up across the board, building as we get closer to the opening bell. S&P futures up 0.2%. Expectation the Fed will be green-lighted to cut rates. The latest inflation data about to cross with Michael McKee in Washington, D.C. We are still waiting on some of those numbers. It does seem like the market expects the Fed to look through, Mike, any potential bump up in inflation, even if we do see that.
Well, the markets are basically not expecting a huge change, and we don't really get a huge change, although the PCE price index for the month of August is up at 0.3, which is, as forecast, a little higher than it was last month, puts the year-over-year rate at 2.7%, just as forecast, and the core rate comes in at 0.2, same as forecast, a little lower than last month, and that leaves us at 2.9%. So no real change in the inflation picture, although, as we talked about with Tom Barkin earlier today, it's not getting any better. It's just not getting any worse in the month of August. Personal income up 0.4%. What we need to do here is see what the wage and salary component of that is, and I'll check that out. But personal spending comes in stronger than anticipated, up 0.6%. The forecast was for 0.5. It was 0.5 last month. So far, no revision. Let's see what we get in the next few minutes. But basically, it shows the American consumer hanging in there, and it looks like they have the incomes to do that. And maybe the economy is a little stronger than expected, which takes us back to Mr. Barkin and what he said about the downside risks maybe are a little bit less prominent than they were before we got the revisions yesterday to GDP and before we get these numbers today.
Mike, I'll give you a second to go through all of the line items just to give you a sense of what the market reaction is. We aren't seeing much of one, maybe just a little bit of an increase in yields, but now lower on the front end of the yield curve. Essentially, people looking through any kind of strength saying inline is a beat almost in a good way. The idea that we could potentially see a Fed that justifies cutting rates. We didn't see that upside surprise in any kind of dramatic fashion, and I think that was what people were most concerned about. You could see it across the board down by about a basis point. 2s, 10s, and 30s. When you take a look at what that means for the equity picture, well, it's not a disruption, and that's a good thing. And so you are seeing gains continue to build. That was clearly the fear in markets, that maybe we would get an upside surprise that could hamper the Fed's cutting plans. Russell 2000 up 0.3%, a market shift from earlier this morning, up about 0.5% from some of the lows in futures earlier in the session. You could see NASDAQ up about the same, as well as S&P. And then when you bleed it through the currency market, dollar weakness. I guess cutting back on means the dollar can rally versus the dollar can weaken versus the euro. The euro can continue its rally after 2 straight days of dollar strengthening. Mike, you've had a couple of seconds to look through all of the information. Does anything stand out to you?
Well, one thing that stands out, Lisa, is that personal income, wages, and salaries were up 0.3 in August. That's a climb down from what we saw in July, a 0.5% gain. But does that mean that we're going to suddenly turn cold? Hard to know. It'll depend on the continuation of all this, whether people still feel they have the money. And of course, we did get all these additional tariffs overnight. So that's going to be a question of how people react to that. I'm not sure that tariffs on some big trucks are going to cause people to cut back on spending, but it might affect business spending. But if we do see tariffs continue to be put on goods, especially on prescription drugs, that could have an impact on confidence, which is a little tease ahead to 10 o'clock this morning Eastern time when we get the Michigan confidence figures.
Michael McKee, thank you so much for breaking that all down. If you're just joining us right now, we did get that core PCE figure, which came in bang in line, 0.2% increase following a 0.3% the prior month. It was revised downward for the prior month, 0.2%. Personal income and personal spending, that's where it gets pretty interesting to me. The idea that you could get an upside surprise on both, particularly personal spending, 0.6% increase versus a 0.5% increase expected, and real personal spending increasing 0.4% versus a 0.2% expected. And it was actually revised upward in the prior reading as well, Annmarie. It seems like people keep spending, and that has been the engine that keeps on giving to the American economy.
People keep spending. Jobless claims yesterday, very strong number. And now when it comes to PCE, bang in line. So what is there actually, you look at the data like this, what is there actually to worry about? When I do see spending, though, increasing, I do wonder how many people are like members of my family who went out concerned about the tariffs and are continuing to spend now. And they are concerned about the holidays coming up, and they don't want the prices to go up. So they're willing to go out and spend a ton now. I guess it remains to be seen.
Yeah, that's one reason why people are listening to earnings. Former St. Louis Fed President Jim Bullard joins us now, and I'm so excited to speak with you, Jim, because right now I'm looking at all of this data that suggests a really strong U.S. market, a really strong U.S. economy, people continuing to be able to spend and their incomes rising. What about this picture makes you think that the Fed needs to be cutting rates more aggressively?
Yeah, thanks for having me. So these numbers look to me like they're consistent with what markets were expecting. I think markets have a reacceleration hypothesis, and I'm sympathetic with that. So I do think the economy will be in pretty good shape for the rest of this year and into 2026 as some of the new administration policies come online. On the inflation side, there's no surprise here. So that seems to be very consistent with the committee's story that they'll be able to look through inflation and then expect it to fall in 2026. So I think this leaves everything on track to have further rate cuts during the next two meetings of the FOMC.
Just to put this into perspective, this is what the market was expecting. And so there is this rally across the board as people say, OK, the Fed can keep cutting, even though you are seeing this strength and potentially reacceleration, Jim, as you were putting. Yet year over year, core PCE, that key metric that the Fed looks at, is at 2.9%. It's not climbing. It might even be going down to 2.8%, but it's still almost a full percentage point above 2%. Is there a feeling that it just isn't really important to get it down to 2% that quickly, and so you can look through that?
No, they do want to get it down to 2% over the next 2 years. So you want to asymptote into 2%. I would say not go very quickly to 2% or go under and overshoot. So I think, usually the way this is thought about is that you want to gradually bring it down. I think the committee's on track to do that. And so that part looks pretty good.
So is the committee almost looking through inflation? Have they been given the green light by the Fed chair to look through if there's going to be any hot prints upcoming when it comes to inflation?
Yeah, I do think that the chair at Jackson Hole very much signed on to the idea that any inflationary effects coming through the tariff channel would be smaller than previously anticipated, and they're coming later than previously anticipated. And so because of that, this is basically a look through. So even though you say, like President Barkin said, well, it's not getting any better, for those that thought there was an important tariff component to inflation, that part should go away since that's a one-time effect. And so that's giving the committee confidence that they can go ahead and get to closer to neutral. They'll still have still be a restrictive policy, still putting downward pressure on inflation, but not as intensely as what they're doing right now.
Well, when it comes to inflation, we heard from Governor Myron almost insinuate, not right now, but maybe in the future, the Fed should actually have more of a range in terms of their target. Could you see the Fed moving towards that, maybe targeting 2 to 3% instead of just 2% across the board?
Yes, a classic issue in inflation targeting. The U.S. has come down on the side of just having a target. It's simpler communication. It doesn't leave ambiguity around having a range. One of the problems for countries that have had ranges is that, the top of the range then becomes okay as opposed to the midpoint of the range. So it can be interpreted as slippage in your commitment to keep inflation low and stable. And households do not like the inflation. So I think it's incumbent on the Federal Reserve to make sure inflation stays low and stable.
Jim, I'm trying to get a sense of how a data-dependent Fed deals with the potential of not getting data. Next week, we're supposed to get the non-farm payrolls report on Friday, October 3rd. Ostensibly, that could be after the government shutdown, where we do not get that data print. How problematic would that be for the Federal Reserve, given how balanced right now a lot of people feel the risks are?
Yeah, well, it's disturbing to not get as much data as you can on the state of the economy, and so that would be a concern. But the Fed has managed through that in previous episodes around government shutdown. So I think it's manageable, but it's not an ideal situation.
It feels like a really messy moment because not only are there questions about the integrity of the data, when we get the data, which data to look at, what the data is measuring, but there are these sort of sea changes that are overlaid on top of it, whether it's different areas, different income earners that are earning a lot and able to spend, lower income workers that are feeling the pinch of inflation and not seeing the same types of labor gains. I just wonder if the Fed should think of a new paradigm, a new benchmark to understand exactly what the optimal employment level is and how they should weigh these two risks.
Yeah, I do think it's a good time to review our models and think about how are we going to do this over the next decade? Could we do better than where we've been? I think we've been more or less preoccupied with the pandemic and the reaction to the aftermath of the pandemic, but that's pretty much behind us now. So now would be a good moment to really do a thoroughgoing review of how the Fed operates and how the models work. I guess one thing I'd like to do is have I'd like to do what other central banks sometimes do, is have a parallel process where you have a new model getting ready and run that in parallel, and then have a cutover point at some point in the future where you actually switch to the new model. So I think we could do things like that, and that's maybe something to consider at this point.
Governor Lisa Cook is warning, her attorneys are warning that the removal of her could cause chaos and disruption in financial markets. What do you think the reaction will be in financial markets if she is removed?
I think that the court will insist that she gets due process for whatever charges have been made against her, so that that would prevent political partisans from just making charges against members of the committee without having to prove those charges, and then calling that cause and allowing people to be dismissed from the FOMC on that basis. So I think that the people on the Supreme Court will make the justices will probably come down in some way to protect that due process clause.
Former Fed President Jim Bullard, thank you so much from the St. Louis Fed, now currently at Purdue. Thank you so much for being with us, and of course, a potential candidate to be the next Fed chair. A real question here about how to weigh the risks, given the fact that what you are seeing is strength. You're seeing strength in the consumer in particular, which just keeps on spending.
Strength in the consumer, PCE is coming bang in line, and also the jobless claims yesterday pointing to maybe actually labor market is holding up. I love your question, though, about the data. What if the data-dependent Fed doesn't have the data next Friday?
You look at other data, and that seems to be the answer.
How do you cut, though, out the data?
But it creates a very complicated moment. Right now, let's get you an update on stories elsewhere. Here's your Bloomberg Brief with Yahaira. Yahaira.
Hi, Lisa. I want to start with the recap of the latest economic data you just broke a few minutes ago. Core PCE rose 0.2% from a month ago, in line with estimates, as did the broader PCE, up 0.3%, while U.S. personal spending rose more than forecast as the consumer remained resilient. Meanwhile, Amazon is paying up to settle a lawsuit from the FTC. The company will pay $1 billion in civil penalties and refund $1.5 billion to customers to resolve allegations it misled millions into signing up for Prime and then making it intentionally difficult to cancel. Amazon customers will receive refunds of as much as $51. And the 45th Ryder Cup is officially underway, teeing off this morning at Bethpage Black in New York. The opening match features the American duo of Bryson DeChambeau and Justin Thomas taking on Europe's Jon Rahm and Tyrrell Hatton. The world's #1 player, Scottie Scheffler, partners with Russell Henley for Team USA's second pairing today, and President Trump is set to arrive around midday. That's your Bloomberg Brief, Lisa.
Thank you so much, Yahaira. Ryder Cup, John off. Coincidence?
I know, right?
I don't know.
I don't think it's a coincidence.
Up next, Ryan Wang of HSBC as we break down the latest inflation data. Plus, Danny Berger with your morning movers, easing restrictions, lifting Boeing and Spirit Aerosystems. This is Bloomberg Surveillance.
These numbers look to me like they're consistent with what markets were expecting. I think markets have a reacceleration hypothesis, and I'm sympathetic with that. So I do think the economy will be in pretty good shape for the rest of this year and into 2026 as some of the new administration policies come online.
That was former St. Louis Fed President Jim Bullard talking after we got that core PCE data, as well as personal income and spending exceeding expectations. Core PCE coming in pretty much in line, which was a beat for markets. Markets are rallying on the heels of that. You could take a look at 2-year yields, 10-year yields, and 30-year yields, all lower on the heels of data that shows no surprise. And that was really the story. 10-year yields have been pretty stable around that 416, 2-year yields at 365. If you take a look at what that means for equities, well, it means what it does mean these days, which is equities up. Not necessarily the torpedo for the Russell 2000 that people were worried about 2 hours ago. Right now, up almost 0.3%. Similar moves across the other indices. And if you bleed it through the foreign exchange, you could see a bit of dollar weakness, euro strength, under 45 minutes away from the cash open. Let's get to your morning movers with Danny Berger. Danny.
Hey, Lisa, some news from the Journal in the past hour, and that is sending Boeing shares higher by about 4%, and one of its suppliers, Spirit Aerosystems, up 3%. The FAA looking at easing some of the restrictions on Boeing that would allow employees to have more of a say in the final safety sign-offs and less involvement from the FAA itself, easing of those regulations, sending shares higher this morning. In other D.C. news, also from the Journal, moving shares this morning, is a plan for the Trump administration to get more chip companies to use homegrown manufacturers. So that's benefiting Intel this morning. Shares are up 4%. Global Foundries, another domestic chip manufacturing business, up 8.4%. Finally, pharmaceuticals on the move this morning after Trump said that there would be an 100% tariff on patented drugs if they do not have manufacturing facilities in the U.S. So the U.S. companies that have been working on building in the U.S., those shares are moving higher. Eli Lilly, Merck, AbbVie, all of them up by more than 1% this morning, Lisa.
Thank you so much. And thank you so much for this morning, Danny. Right now, let's turn back to today's core PCE results. We did see that in-line reading of 0.2% as expected. Ryan Wang of HSBC joins us now. Ryan, thank you so much for being here. It's great to have you on a Friday. What was your takeaway from the data?
Yeah, thanks so much for having me. Well, the data was pretty close to expectations. I do think still it's important that the year-on-year rate of core inflation is getting ever so closer to that 3% level. It actually doesn't matter what measure of inflation you look at, headline CPI, core CPI, either of the PCE measures, they're all running close to 3%. That's not as high as it was a couple years ago, but it's still, of course, significantly higher than the Fed's 2% target.
So are we being gaslit when people say it's just going to keep its downward trajectory? Is this the real reality that we're at a 3% inflation level, and that's probably where it's going to continue, even as we talk about some sort of asymptotic progression to 2% over the next 100 years?
Yeah, well, that's a very good point. And actually, our own projections do have us staying closer to 3% than getting down to 2%, even in the next 12, 18 months. I think that's very much the case. We've heard clearly from Fed Chair Jerome Powell that, okay, you can call tariffs a one-time effect, but that's a one-time effect that can last several quarters, well into next year, maybe even beyond, as the full effect of those tariffs comes through. And, at that point, we have to say, well, what is that going to do to inflation expectations along the way?
So has the Fed basically just accepted 3% inflation without coming out and saying that's our new target, to Lisa's point?
Well, I think
they moved the goalpost on us?
I think this is why you see the divide on the Fed, because clearly inflation is running slower than it was a few years ago, yet it never reached that 2% level. So you're never going to hear any of the Fed policymakers say that, okay, they just reaffirmed the 2% target. They're not going to say that 3% is acceptable. But simply put, I do think it's more likely that we'll be closer to that higher number through the end of next year.
What do you make of the tariff impact right now? And I say this on the heels of last night, us still trying to digest exactly what is going to be tariffed in terms of kitchen cabinets, bathroom vanities, furniture, upholstery furniture, all these new sectoral tariffs the Trump administration announced.
Yeah, well, we're entering Act 2 of tariffs, right? I mean, all the focus up until this point has mostly been on these reciprocal tariffs, but those have had significant sectoral exemptions, and now those exemptions are being filled in as we get these proposed tariffs on these products. So that's just another reason why, the full story of the effect on consumer prices has yet to be felt. And yeah, we're going to be watching really in the rest of the year. It's going to be those sectoral tariffs that I think take most of the airplay.
Just to wrap up a week where we've gotten a lot of commentary, a lot of bullishness on the economy, on the idea of a Fed that was going to be cutting rates even into strength. I'm struck by what Scott Cronert of Citigroup had to say when he was talking about how it feels like there are two different markets. It feels like there are those that are touched by AI and the investment cycle that we've seen, and it feels like there's everything else, which hasn't necessarily been as leveraged to the gains that we've seen in markets, to the gains that we've seen from AI, and the other types of rising tides. And I just wonder how, when you look at this aggregate data, you can parse that out and understand why some people might be feeling really rotten about the pace of inflation and the state of the labor market, while other people feel pretty good and are flying around the world.
Yeah, well, I would say the macroeconomic data do actually bear out some of this characterization that you just said, because really since the start of this year, economic growth, we just got new GDP numbers, will probably be below 2% when this year is done. But we won't necessarily be below 1%. Right. So despite all the focus on the weaker employment growth numbers that we've seen come through in recent months, actually the expenditure data, the GDP data, the output data have held up reasonably well. And I think that speaks to this split where, of course, those that are seeing that hiring activity is slower, those trying to get a job are really being impacted by that softer job market. Prices aren't any lower, regardless of how you're faring in the labor market, right? So again, it speaks to that inflation. But at the same time, company sales haven't necessarily weakened in the way that the most pessimistic views would have thought a few months ago.
This is a confusing moment and a fascinating one. Ryan Wang, this has been wonderful. Hopefully we can do it again soon. Ryan Wang of HSBC joining us here on set. Just really fascinating to see the data come in stronger than expected when it comes to personal income and spending. You saw inflation come in line around almost 3%, core PCE, yes, below some of the 5 and 6% levels that we had seen a couple of years ago. But it just points to this idea that the market and the Fed seem to have accepted a 3% inflation rate where it is, and don't seem to be in a rush to really get it down.
Mohamed Al-Erian's been talking about this way before Steve Myron was highlighting that potentially we might have to target a band because they failed in getting inflation back 2%. That's what it is. And it's going to be years until they get it there. And if you're going to cut rates because you're concerned about the labor market, you tactically already decided we are accepting 3% inflation. You're just not saying it out loud.
Maybe it's just a journey. It's not necessarily the destination. Coming up Monday, Tony DeSpirito of BlackRock, PIMCO CEO Manny Roman, Henrietta Treyz of Veda Partners, and Jonathan Gullop of Seaport Global. Do not miss that. This was Bloomberg Surveillance. Have a wonderful weekend.